Thank you to all of you for being here. I am welcoming you to the first technical session of this roundtable. My name is Sophie Trémollet. I lead the water team at the OECD, which has been behind the organization of this roundtable. I'd like to congratulate and thank Lila Davis, who many of you have been in touch with, who's been a real kind of mover and shaker in this whole debate. So at the OECD Environment Directorate, we work on water, finance and economics in particular, and we've been, most of our work is interacting with Ministry of Environment with a key objective of mobilizing greater investments for water. And we seek to identify ways to accelerate investments for water because the value of water for many productive sectors, for agriculture, for industry, for power production, for navigation, is not adequately recognized and funded. So despite this very significant value of water, what we find is that there are significant investment gaps. In the European Union alone, for example, the OECD estimated in 2020 that the total cumulative expenditure needs would be 289 billion, and that all 27 members of the European Union, except Germany, would have to increase by at least 25% their investments on water for investing in aging infrastructure, for dealing with pollution, for fighting flood risks, etc. For low and middle income countries, of course, the gap is even bigger because the World Bank estimated that 6.7 trillion needed to be invested by 2030. 22.6 trillion by 2050, and that it means that for many countries, they would need to multiply their investment by a factor of 20. So with support from governments of the Netherlands and in collaboration with the World Water Council, we've been organizing these roundtables since 2017 so that we can bring the water and the finance community together to try and address this gap. And it's the first time we do it with a central bank, because our theory of change, if you want, is that if central bank, as we've heard from the sub-governor, start saying that water is a significant risk and is underpinning our economies, then policymakers, ministries of finance will start paying attention in a different way than if that message is coming from ministries of environment or from environmental NGOs. So this is why we decided to organize it here in collaboration with the Bank of Spain. And we hope that the authoritative voice of the central banks will then lead to unlock the necessary policy reforms and implementation of policies that we need in order to reallocate water resources, to price it better, to reflect the true value of water in pricing, and to address all the other issues such as governance fragmentation, like, for example, that Mathilde alluded to. So in this first session, we're going to look more specifically at water-related risks. We're going to look at the results of recent studies that examine how this can translate into inflationary pressures. And we'll start hearing from a number of central banks that are doing work on this issue. And I'm pleased to be joined by a stellar panel of speakers. I've looked at their bios. They all have a PhDs, so we have a very, lots of brain power here, with the commonality that you all have a PhD in economics, except from you, Nicola, who has a PhD in atmospheric physics. So we have a science represented here as well. So first of all, we'll hear from Elias Albagli, who's from the Central Bank of Chile and has been involved in the work of a network for greening the financial system, Nature Task Force, as the co-chair. We'll then hear from Nicola as well, who's the executive director of the Earth Capital Nexus and professor in practice of natural capital at the Grantham Research Institute at the London School of Economics in London. We'll then have the pleasure of welcoming two central bankers, Salome Talotse from the National Bank of Georgia, who's head of Sustainable Finance Division, and Irene Alvarado Quesada, who's research economic in the economic division of the Central Bank of Costa Rica. And last but not least, we'll hear also from Edouard Perard, who's representing probably the largest investor in water in the world at this stage. The European Investment Bank is a real powerhouse in this area, so we'll hear from their experience of investing in water. So without further ado, I'd like to ask Elias to tell us a little bit more about the work of the NGFS Task Force on Nature and how we can build on what has been done already by this task force so that we can focus more specifically on water-related risks. Thank you. And you have slides, so I think if we can have the slides. Thank you.
Thank you, Sophie. And thank Banco de España for this invitation. It's a real honor to be here. I think these are Nicola's slides. We could have the other slides.
Yes, we'll ask. Just go back.
So, well, I'll introduce myself before. I am the chief economist of the Central Bank of Chile. That's sort of my main job, I guess, the monetary policy aspect of macroeconomics. But I've had the honor of participating at the NGFS in different capacities since 2018, more or less. And since early this year, I've been honored with co-chairing the Nature Task Force as well. So I guess what I would like to do today, and I'll be more clear once the slides show up, but just to give you an idea, I would like to talk a little bit about, from a more conceptual point of view, how central banks are starting to think about the interaction of macroeconomics and nature, and how the NGFS is trying to help this process, particularly with the Nature Task Force. If I remember more or less the slides, I think I would like to start by going to the main tension that we have in macroeconomics and nature. Nature provides many services for us. We call ecosystem services. And we've already seen a little bit in the first presentation. We'll see more throughout the day. Ecosystem services are of different types. We have the ones that we can visualize more easily. Next slide, please. I guess a couple of slides into the talk. Right. So, okay, great. Let's leave it here for a while. So, what's the central tension? Is that we don't have much difficulty in visualizing some ecosystem services that we receive, which the ones that we term the provisioning services. So agriculture, materials, energy, and of course, water availability. But we have a much harder time understanding the dependencies of our economies, of ourselves, on the other ecosystem services, which are, regulating, supporting, and cultural. In particular, regulating and supporting, because they work sort of in the background. They allow ecosystems to exist, to function, and basically provide all the other functions indirectly. The central tension is that as economies expand, we demand more of the first type of services. They usually have a price in markets, but thank you. But that requires us to do some changes in our economies. Particularly, they require land use change, they require CO2 emissions, they require pollution. And in doing so, the expansion of our economies indirectly and, well, directly, but sort of invisibly, they start affecting negatively the other sort of ecosystem services, the ones that are less visible for us. Okay? That's the central tension. We overexploit one type of services at the expense of the ones that are not so visible and don't have a market price. So that's my way of understanding what the NGFS Task Force on Nature is trying to figure out. right? Analyze and provide guidelines to central banks and regulators on how to incorporate this two-way interdependence between nature and macroeconomic and financial risks. So in other words, try to make more visible, more clear what this interconnection between one type and the other types of services are in our economies. This is sort of a very interesting, it's beautiful really, but it's also very complex task. So the main building block that the TNF underwent a couple of years ago is to define the conceptual framework. Okay, so how are we going to understand this whole discussion conceptually? And the framework essentially tells central banks and supervisors to structure their discussion and their analysis in roughly 3 stages. Okay? And actually, this goes back to the presentation we just saw in the earlier sections. It's a very similar sort of framework. First, we need to identify stressors. Where are the shocks coming from? So what are the sources of physical or transition risks or impacts? For example, physical could have either risks that materialize in the long term, right, where we call chronic, or they might be acute, as for example, flooding, desertification, wildfires, droughts, etc. We can also have transition impacts, such as environmental policies or changes in consumer preferences that may have impacts on certain businesses and the value of assets. So that's sort of the first stage. The second stage is to uncover the economic transmission mechanisms between these stressors and outcomes at the level of different industries and then at the macro level. Okay? That's sort of the main, that's where the economics really comes in. And the third stage is to translate these effects on different economic sectors and on the macro as a whole into the more specific financial risks. And that's also a challenging task because it requires getting from the very top down to the bottom up, so to speak, right? Because you need to map the risks at the business level, then aggregate that to the bank or the financial intermediary level, and then to the more system-wide level. Okay, so, but essentially, that's the conceptual framework. The conceptual framework was published in 2024. You can see the link there, and I really encourage you to read it because it's quite informative. It's also very intuitive, but gives this very clear timeline and recommendations on how to start incorporating these aspects into macroeconomic and financial risk analysis. Where are we now in the TNF, in the task force nature? Roughly the second phase, right? So basically take this conceptual framework and try to apply it to real world applications. We are now, a couple of months ago, we put forth a publication what we call the Nature Package. It has different documents in it. I invite you to read that as well. And we are about to publish later on at the start of the second semester, probably, a compendium of practical applications of the conceptual framework. So let me give you just a couple of highlights. You'll see more if you read the document once we publish it. There's an interesting analysis in France that relates to the vulnerabilities of different businesses to water risks, particularly in the industrial sector. So think about the water shortages, rivers that get really drawn down, and this type of exposure. Something similar in Germany, but with a more sort of financial angle to it. So particularly the exposure of financial institutions to water-related risk via corporate lending in the portfolios. There's also a very important case study for Brazil that studies the physical risk related to agriculture and livestock sectors in the Amazon. So Brazil is a really interesting case. So for those of you who don't know, Brazil has already done the energy transition. I mean, 90% of their energy is renewable. So that's not the issue. The issue is that their emissions come from land use change. And that's at the heart of the economy, right? Agriculture. And it's the heart of the Brazilian economy, but it's also at the heart of biodiversity for the world. So nature, I would say nature for Brazil is much more important than the climate discussion, right? We also have a couple of case studies on transition impacts. And let me say a few words on the case of Chile. I participated in this study. Here we use an Earth economy model. So it's basically like a macro model that is spatially explicit. So there's land use change decisions that feed into the decisions of economic activity in different sectors. But they also affect the provision of ecosystem services because they can degrade or enhance ecosystems. So with that type of framework, what we analyze in the case of Chile is what would happen to ecosystem services and to the macroeconomy as a whole if we actually implement the nationally defined contributions in the relation to land use change decisions related to forest management, just in that specific case, forest management. And in doing so, we analyze different ecosystem services, many of which relate to water. And we find very interesting results. First, we show that the forest management policies, through the enhancement that they do to ecosystems, are more than enough to meeting the NDCs. That's important. And the second, and this is perhaps more surprisingly, we find that there's no real trade-off for the macroeconomy as a whole, because these policies, on the one hand, enhance ecosystem services, so they're good for nature, but they also increase employment and output throughout the positive effects that they have on ecosystems and how different sectors depend on those ecosystem services. I don't know if this is going to be more generalizable to other countries, but I hope it is. I mean, if you increase and you enhance nature, that tends to be good for economies as a whole. So this trade-off that we think there exists maybe could not even be there in the first place. I'll finish with this slide. Let me just say one important idea in the case of water-related ecosystem services. Okay? Some insights that we see from these case studies. First of all, we didn't direct specific case studies, you should focus on water and you should focus on so on. It's countries, come up and say, this is what we're interested in. And there is a clear, I would say, bias towards ecosystem services that are related to water. And that speaks to the centrality of water, both for ecosystem services and for our economies. Okay? First, there are direct effects that come from these studies. Water availability is a critical input in a Leontief production function sort of way, in the sense that you need a fixed amount of water to have the production process to begin with. If you don't have water, there's no substitution away from that. So it comes directly in for example, the production in mining in Chile, very important water. Agriculture, industry, transport, tourism, water is like a direct input. Then it also appears indirectly, because water is like the blood in the human system, right? If you take that away, ecosystem services, the other ecosystem services, they don't exist either, because ecosystems cannot function. So water enters indirectly in these other ecosystem services. And finally, water also enters directly, not so much in economic activity, but in the value of many important assets, right? Such as private property, infrastructure, and assets that are important for production processes at firms. So this is what comes up when you read the whole, the meta study of applications. Water is basically all over the place. With that, I'll finish here because I don't want to take more.
Thanks a lot, Elias, and thank you for pointing out as well the benefits, because we're talking here, our focus is on water-related risks, but demonstrating the value of investing in water and that it's positive for nature and the economy is very important, of course. So now I'd like to turn to Nicolas to tell us more about the recent work that you have done to assess the related risks, water-related risks. Yeah, if you can, and I hope you get the right presentation this time.
Thank you, Sophie. Good morning, everyone. It's lovely to be here with you today. So I'm Nicola Ranger. I work for the London School of Economics. Our research is particularly around the challenge that Kate mentioned in the introduction, and we just heard from Elias as well, around how do we go from understanding water, which I think we all understand as being macro-critical to our economy, into financial risk. And in doing that, there are a number of challenges, quite significant challenges. And certainly I would not say that anyone has cracked it yet. But I'm going to just talk briefly about sort of what we know based on the evidence and what are some key conclusions that we can already draw out. So I'm going to show you some new research that we've done, but I'm not going to focus so much on the numbers because I think it's more about what is the story that it tells that is important from a financial management perspective. So I'm only going to show you one slide. So I was particularly asked to talk about what are some of the transmission channels between water and the financial sector, and what do we know about those? So this is sort of showing this table here on the right-hand side. So we did an analysis last year, led by a colleague of mine, Jimena Alvarez, with the TNFD, and looked at reviewing the literature. So we reviewed over 600 sources of information around nature-related risks more broadly, but particularly water-related risks came out as one of the areas where we had the most evidence. And what we found is that there is a huge amount of evidence around the impacts of water on different sectors, less evidence around how that then translates into an economic risk, and certainly the weakest evidence on how it translates into a financial risk. And when I say weak evidence, I don't mean that it's not evidence is not happening, it's just there's not a lot of studies that have looked at that yet. But what we found is that in terms of the transmission channels, that I think are important. So one is, there's really high evidence around the impacts on agriculture. And I think we would all know that. And for example, the ECB recently has done a lot of work looking at empirical analyses around the impacts on drought and agriculture and the economy across Europe, and found that droughts can lead to persistent declines in output across Europe. So for example, quoting the 2023 study they did, a 3% lower output at a regional level 4 years after a drought shock. And a lot of that is coming from agriculture, but in particular it's also impacting on manufacturing and industrial production, energy sector as well, but also importantly the supply chain aspect of this. And I think this is really critical because I think we often think about water and its direct impacts, but certainly in the research that we do and others have done, it's these indirect impacts that are really important. What we find is, so the evidence around financial contagion and systemic risks is still in the low to medium, but potentially very, very significant. And I'll show you some of the work that we've done on that. See, the inflation transmission channel is very important as well as things like insurance. There's a lot of focus on now. So how insurers could be pricing this risk and the feedback effect of that. So this is sort of where we are. So what do we then know about the financial risks associated with that? So we've looked at basically linking understanding of water-related shocks through these transmission channels, in particular both the direct impacts, but then also the supply chain impacts, and looked at the financial risks of those to the globally systemically important banks, which is what's shown here. So we haven't named the banks, we've just got bank 1 to 29 here. But some of the key takeaways from this analysis. So one is that these risks are macro-critical to financial institutions. So again, I'm not going to focus on the numbers, but certainly the numbers that we get out are, in the range of a couple of percentage points losses to bank portfolios. So in the same kind of range that central banks would usually use for a systemic risk stress test. So in the sort of low trillions in risk. And what we find importantly, and this is why I think is really important from a supervision perspective, that actually just looking at your risk to individual assets doesn't tell you the whole story. It's these risks are correlated across economies, and they're also correlated across the world. So particularly if you're supervising banks that have exposures globally, like the globally systemically important banks, but also others, actually understanding the correlation of those risks across countries is really important. And we find that is amplifying the risks significantly, particularly for these most significant banks. The other thing that we're finding is amplifying the risk is the interbank networks. So all of these banks are interconnected, and that's creating another level of amplification on top of that. So in terms of understanding the potential systemic risks, I think that the key conclusions here are, one, yes, this is a macrocritical risk that deserves some to be looked at very seriously. Two, that understanding the supply chain aspects of this and the risks to sectors dependent on water like manufacturing and energy are really important as well. So it's not just about agriculture. Three, understanding risks across countries and across banks and their interdependencies between the banks themselves is critical. So again, I think for supervisors, this means we really need to start looking at how can supervisors work together to analyze risks across jurisdictions as well. A final aspect I want to bring in, so one of the new pieces of this analysis, which is now on SSRN as a draft paper, welcome your feedback, is the role of disclosures in this. So in this analysis, we worked with CDP, thank you very much to CDP for the data, to look at if we bring in more information about what individual firms are actually doing based on their disclosures, how does that change the analysis? And one is we found that actually the risks increase. So a lot of these types of forward-looking analysis are often based on tools like Encore, which are fantastic tools, but very, very broad. But if you replace Encore with a more detailed understanding of risks of the vulnerabilities based on disclosures of firms, you find a very different picture. You find much greater heterogeneity across firms, and for some firms, certainly much greater risks. So an additional conclusion of this work is that really understanding what individual firms are actually doing and how vulnerable they are is very important. And you can see here between the blue and the orange lines, this is showing the original Encore type analysis versus the CDP, and you can see the CDP analysis is both bigger, but it's also changing somewhat the ranking. And the final point is just how different it is between banks. So you can see here, and certainly banks with greater exposure to agriculture have some of the biggest risks, as you'd expect, but also, the exposures across geographies is also leading to significantly different risks across banks. Thank you.
Thanks a lot, Nicola. So thanks for pointing out these transmission channels of risks. So I'd like to turn now to our two central banks representatives, starting with you, Salome, who works from the National Bank of Georgia. So we heard this morning of the example of Kyrgyzstan. Similarly, I guess Georgia is very exposed to risks which are associated with transboundary risk and energy security. So could you tell us a little bit more about how the National Bank is thinking about these risks showing up in the financial system and what supervisory response is starting to take shape? Thank you.
Thank you, and thank you for the invite to speak on this important topic today. So quick word on our mandate because it shapes our approach. So National Bank of Georgia is not only a central bank, but financial regulator. So we supervise the whole financial sector, except insurance, which is very tiny in Georgia. So looking, taking into account climate, nature, and water-related risks sits very well in our monetary policy, financial stability, and supervisory remit. Another thing I want to mention is that work we do on related to nature risks is part of our overall sustainable finance framework, which we started to develop in 2017, so quite early. And we are now in the phase of implementing second roadmap, second action plan, and over years we managed to develop a comprehensive framework that covers all key pillars of sustainable finance, risk management, sustainable finance market and products, disclosure reporting, which is also very important, as well as awareness raising, capacity building, cooperation, both domestic and international, and research and analytics. So all these are supporting pillars. So in our case, analytics and research we do fits in and is related to policy and regulations. Regarding to water-related risks in Georgia, so we know that water risks are very diverse, right? It can be chronic, acute, transition, physical, so quite can take a different forms. And Georgia is exposed to all of them, almost to all of them. So Georgia is a very small country, but it's very diverse in terms of hydrologically. So we are exposed to droughts and water stress in eastern part, we are exposed to floods and extreme precipitation in western central Georgia, and we have glacier melt and in the mountains. So very diverse of risks, and we already see from our historical experience material water-related risks in Georgia. So in 1999 and 21 drought that was very severe, cost around 6% of GDP. And then in 2015 we had Tbilisi flood, and the 2023 Shawi disaster, which was a result of a glacier melt that caused several deaths, as well as big impact on in infrastructure and tourism. So we already have these examples, and as I mentioned, the risk is quite diverse, so we tried to use diverse approaches to analyze these risks. The starting point in our case was at our 2023 paper that where we try to analyze biodiversity-related financial risks first time for Georgia. So we are among the first central banks who started looking at this topic. So this was done at a sectoral level, at quite high level, but the results were striking. Like 46% of lending portfolio to corporates was exposed to moderately highly or very highly to ecosystem services, and in terms of impact, it was 54%. And another interesting result was that, especially in terms of dependency, it was mainly related to water-related ecosystem services. In parallel, we ran a climate stress test, and one of the severe physical hazards that turned out to be like material was extreme precipitation. And under the severe scenario, it had quite material impact on non-performing loans and capital ratios, not systemic, but still material. In terms, from the perspective of monetary policy, here we are mainly looking at droughts and how it can create inflation pressures, mainly through agriculture. And as part of NGFS macro modeling initiative, we are developing weather shocks model that and through that, we are trying to analyze these channels. And another dimension I want to mention is transition risk, water-related transition risks that is frequently overlooked when we talk about water-related risks. But in emerging countries, water-related policies, pricing, and regulation can change very quickly, and it can affect production costs. It's a kind of, and then prices, and mainly maybe create inflation pressure rather than financial stability issues at this point. But that's what we are trying to analyze as well. We faced a lot of data challenges in this regard, so we are trying to somehow address this. The thing that puts together all this work is now our current projects that we are doing with OECD and Green Action Task Force. We are very thankful for this collaboration, and here we are building on our 2023 paper, but at this time we are using company level and financial product level data, as well as our input-output table to also look at the indirect effects. So this is still ongoing work, but the preliminary results show that the dependencies can be even higher for the financial sector. And again, water-related ecosystem services stands out. And another dimension I want to touch lastly is we mainly talk about risks, but when we talk about sustainable finance, there is other dimension as well that is we are called opportunity side, or financing for adaptation and mitigation. And our sustainable finance framework is quite broad, and in our sustainable finance taxonomy that banks are using very actively, so Georgian financial sector is bank dominated. We already have biodiversity conservation, water management, sustainable agriculture, and we see that financial sector, like banks, are already starting to finance climate-smart agriculture and irrigation projects. So in this case, for the financial sector can play a key role, not only in terms of managing financial risks associated to nature and water, but also supporting to mitigate and adapt these risks. So let me stop here.
Thanks. Thank you very much for sharing your experience. And maybe we'll cross to the other part of the world and of the room with Irene, because Costa Rica has been ahead of the curve in terms of integrating nature into macroeconomic analysis. So could you tell us what the Central Bank of Costa Rica has learned about how water risk transmits to inflation and price stability, and what type of analytics are you doing right now?
Yes, well, thank you first to the organizers for giving me the opportunity to represent the views of the Central Bank of Costa Rica today in this matter. The water-related risks have been part of our agenda over the past 5 years already in terms of the research agenda, in particular of the economic division. 2 years ago, we published a study on the exposure of the credit portfolio of 50% of the 50% of the credit portfolio of the financial system to extreme rainfall events. This is already a published document. But to address specifically your question on the impacts on inflation, one question that had been posed recently by members of our board of directors is, what do we expect from the current El Niño event that is going to happen in the upcoming months? So we had a very strong El Niño at the end of 2023, beginning of 24, and it had a very strong impact on some of our main crops for domestic consumption, but also for exports, and on water shortages. In Costa Rica, 70% of the electricity is produced by hydropower. So we actually had a couple of power outages, unexpected ones at that time, and it was a whole topic of discussion, both economically but also politically. So one of the main questions is, since now we're expecting a super El Niño, whatever that means in terms of how long it's going to be, how strong it's going to be, how this is going to affect inflation. But for that, it's important to take into account what Deputy Governor Núñez was mentioning before about the context, because how El Niño affects the country depends on where it's exactly located or the particular geographical and topographic conditions of the country. So in some countries of Central America, what happens when you are facing an El Niño, and when I mean El Niño, I don't mean the whole ENSO phenomena, but specifically the El Niño phase, what happens is that you can expect higher temperatures, it's going to be warmer, and the dry seasons are going to be extended, particularly for Central American countries. Other countries like Peru and Ecuador, what you can expect is more rainfall and more risks of flooding. Costa Rica has both effects, depending on where you're looking at it. So when the temperature of the surface of the ocean rises in the eastern part of Costa Rica or the Caribbean coast, because Costa Rica has two coasts, the Pacific and the Caribbean one, what happens is that these trade winds become full of humidity and they become stronger. So when they reach the Caribbean coast, they bring a lot of water. So we expect in that side of the country to have more rainfall, more intense and more frequent rainfall when El Niño occurs. But then in the middle of our country, which goes from northwest to southeast, we have a mountain range, a very high one. So I'm getting very specific here because I think it's important for you to understand the opposing effects, let's say, of this El Niño phase. When the winds reach the mountain range, all the humidity stays in the eastern coast of the country, and the winds cannot pass to the other side. So the northern part of the country and the Pacific becomes extremely dry. We were already expecting to have higher temperatures, maybe 1 or 2 degrees above the average mean, the climate mean that we expected for 30 years also. So the effect differs on where you're looking at it in Costa Rica, and which crops are you taking into account, and where are the water reservoirs located. So When we look back at data from 1977 onwards, on when we have experienced El Niño and how it reflects on inflation, we find that there is a positive but small effect on inflation of around 0.02 to 0.05 percent points on general or headline inflation. So when we bring these results to the board of directors, they say, okay, maybe this is not what we were expecting in terms of what we see actually in the country. Two aspects that we have considered when analyzing these results are, when we look at the domestic consumption of certain agricultural goods, they not necessarily represent a high share of the basic market basket of Costa Rica. So we're looking at headline inflation, not specific disaggregations of inflation. So we do not see it highly represented in this consumer price index. That's the first thing. Second, other crops that are highly affected might not be well represented in this consumer price index, but more in terms of our trade balance, so in exports and overall growth in Costa Rica. And the third aspect is that when there is not enough water in our reservoirs and we have to use other sources of energy in order to produce electricity, like thermal energy, our bill in terms of importing oil becomes higher. However, these electricity costs are regulated in Costa Rica, and these do not immediately reflect in the bill passed to consumers. So sometimes by political decisions, these bills of increasing thermal energy are reflected 2 or 3 years later. So this is why probably we don't see them directly represented on inflation. What are we doing in order to have more detailed results? We're working now on an assessment of agricultural inflation or consumer price index specifically for agriculture and for energy. And we're also using geospatial information to make sure that we can assess which crops are most affected, whether it is because of excess rainfall or lack of rain, and where are they located in the country.
Mm-hmm. Thank you. Well, thanks for sharing the granularity of your analysis as well. It's fascinating that, you know, central bank is talking in those terms, and I think it reflects how crucial it is to your economy. So I'd like now to turn to the water sector representative on the panel, my fellow water sector stakeholder, in order to discuss, you know, how you see that those risks, in fact, are not being priced adequately and not leading to the right type of investments that we would like to see. So from your experience, where do you think are the greatest needs for investing in water? And could you tell us a little bit more about what you're doing to address that through the, you know, water resilience program, through the Water Forward initiative, etc.? Mm-hmm.
Thank you very much. Thank you for inviting me. Just because you mentioned, just to say 2 words about European Investment Bank. As you said, European Investment Bank is actually the largest multilateral financier of the water sector in the world. It's little known, but it's a European bank. And to give an idea is that currently we are supporting 188 projects under implementation, representing 66 billion euro of water investment, supported by 25 billion euro loans from European Investment Bank. So just to give a context and who EIB is. So I want to thank particularly the Bank of Spain, OECD, CDP, NGCF, and NGFS to organize this conference to link water with financial sustainability. This conference would not have happened, I think, 10 years ago, so things are really changing. It's very clear now that water is not just an environmental issue, it's actually a critical strategic infrastructure for the economy. And we have water shocks, and water shocks can create, as you showed, inflation, impact competitiveness, productivity, and we need to have a vision forward-looking and integrated. And it's precisely why at EIB we launched a water resilience program to have this integrated approach and strategic approach for Europe and beyond. And I will come back to detail a bit more on that just after. So how do we see the problem of water? So as you mentioned, we're all economists, and so I will not go into details, but it's the question, the problem of public good, monopolistic characteristics. So we have also tariffs are too low, so the economic value of water is not reflected in the price of water, and not reflected also in the evaluation of firms. So firms who are water resilient are not particularly favored. So we see that there are two ways of acting when we meet promoters. Either it's a self-interest fragmented approach. So you have individual promoters, cities, who are developing their own projects for their own interest. More and more we have that, so we see that. And you have the other approach that we would like to favor. It's a more integrated approach that is looking at the full spectrum, the full system, the basin level approach, and that is having creating more benefits for the population. And it's a better way to allocate. It's more cost efficient. It's a better way to allocate the capital. So that's why this approach, that's why we see that for us, it's the essential role of EIB, but all the public development banks, because they have a critical role to play currently to develop this integrated approach in countries, in regions, to provide water security. So to come back to the water resilience program, to give a bit more detail, is that our president, so President Nadia Calvino, when she arrived at EIB, one of the first things she did is that she put water as a priority. And in parallel, in collaboration with the Commission launched the water resilience strategy, and us, we launched the water resilience program to support the water resilience strategy. We have 3 priorities. The first priority, and reflecting the different risks, is access to water. But when we mean access to water, we mean also access to quality water, clean water. So there's a challenge of pollution in many countries, including Europe, with PFAS, which can impact also financial stability and the competitiveness of firms. The second priority is the resilience. So resilience, of course, of communities, but what's new in the approach, it's also the resilience of the economy, so the resilience of productive assets. So we finance, what changes that now we want to finance the full spectrum. So meaning we have more and more projects about financing. We finance water for batteries, we finance water for ultra pure water for microchips, and we are in discussion also with data center as well. The third priority in which that we are pushing is technology and EU leadership. Why? Because the European water sector is leader. 40% of the patents in the world concerning water are coming from Europe. So we are there to support them, to create jobs in Europe. It's good, but not only is the fact that the innovations that are developed in Europe will not stay in Europe. They will have actually impact globally, and it will be a way to address water resilience. So I can develop more maybe later on if you want, so different areas.
Yeah, thank you. Well, thanks to all of our speakers. You've taken a little bit longer than originally envisaged, so I suggest that we hear from the room now, and then maybe we'll have a second round of questions, because I realize that you've been very patiently listening through the 2 first sessions. So I don't know if you have any comments or questions that are either in the room or online, because we've got many people who are online as well. Anything? It's a very domineering room, I realize that. Yeah, the lady here. And the microphone is coming to you. If you could introduce yourself as well and your institution when you ask.
I don't think it.
Can you speak up a little bit? Yeah. Okay.
Thank you. Oh,
that's
I'm interested to hear from the non-bankers what you think, maybe you, Nicola, what you think the capacities are that need to be built in the financial services sector. And I suppose I'm asking you because we can hear, firstly, that there are capacities in the sector. We've got some excellent panelists here, but you said we haven't cracked it. And what is it that we can do to crack this, because we don't have a lot of time on our side?
Yeah, maybe Nicola, do you want to answer this question in terms of where do you see the analytical needs as well, and how they can be built in terms of capacity?
Yeah, so excellent question. I'll sort of bridge to the what can we do about it question piece as well. So we're seeing that a lot of financial institutions, and most of the ones that we've engaged with are sort of UK, Europe financial institutions. They are really thinking about this, as we've sort of heard here as well, but individual financial institutions. And they are conducting the first analyses of water-related risk, particularly the big financial institutions. And they are finding it to be potentially material as well. So there is work going. What we've found, though, when we analyze, again, the disclosures from CDP on water, which I understand is a relatively new area of disclosure for this part of CDP disclosures, is that actually companies are disclosing that they're analyzing a lot, but actually in terms of bringing that into implementation, into how they're pricing loans, for example, how they're allocating capital is not really happening yet based on their own disclosures. So there is analysis, but it's not necessarily translating into action at the moment. That's what the analysis would show. I'd say that in general, the point that I made in my presentation was there's a lot of focus on, how do we analyze risk to this individual asset? And that's really hard, because for a company, like knowing how much their revenue will be impacted by a particular shock, there's not a lot of data to calibrate that. So there is a challenge there. But certainly we found that they're often focusing on the individual asset, and they're not looking more systematically at actually droughts tend to affect whole countries at the same time, whole regions. El Nino was mentioned. That leads to drought across the world. So some areas tend to be drought, some areas tend to be flood. So it means that at the same time, whole portfolios can be affected. And I haven't seen that being looked at. So certainly in terms of capacity building, I think there is a need maybe to bring, it was great to hear you giving a lot of atmospheric physics as well. We need more maybe atmospheric physicists in this area and hydrologists and others. But I think there's a need to build that capability. But just on the sort of what do we do about it question, I think this is really important. And this is the question we often get asked, and we're kind of tilting more to our work, is they say, okay, now we've analyzed the risk, what do we do about it? How do we engage with our clients, our counterparties on this? What kind of financial products could we offer them to help them to make the investments that they need in better water management? How can we be part of providing more investment into the water sector? So I think for them, that's where we see the biggest, that's where they're really asking questions and want to build their own capacity in the sort of so what, and how can we be more part of the solution?
Thanks, and thanks for mentioning El Nino, because that actually reminded me of an excellent book called The Victorian Holocaust. I don't know if any of you have read it, which showed that how, in the Victorian era, the Nino led to hunger spreading around the world. So it's a history book that looks at how it was happening simultaneously in India or in Egypt, because obviously, societies were much less resilient in those days, and there were issues linked to food distribution, etc. So we have perhaps more resilient economies, but the systemic impacts are there, and we can learn from the past, I would say. There's a question from CDP here, Joe.
No.
You can speak loud.
Yeah.
Mm-hmm. I suppose I can repeat the question. So has it always been material, or is there basically an escalation of risks that means that now it's rising to the fore in a more, pressing way, which means that there is central banks are taking up the issue? Maybe I can ask Elias to answer this question, because it's interesting to understand what is moving central banks towards this issue. It's true, we heard from Soledad, for her it was the Dana, in the flooding in Spain. So what is triggering this new type of work on your side?
Yeah, so thank you for that question. So the intensity of nature-related shocks, and probably the most visible ones are related to water, has definitely increased. That's basically the hallmark of climate change, right? It's climate change. It's basically not that we have less water, we actually have more precipitation in the world, but it's not happening where it should. That goes back to the presentation we saw in this morning. Countries are waking up to that, and there's a lot more interest in understanding how to deal with them, okay? But we also have to understand that I remember when I started going to the NGFS meeting in 2018, 2019, it was really hard to actually get your question across because it was full of people. I mean, there was a lot of interest from central banks. Everybody wanted to start understanding these issues. And since then, we've had two big wars, and AI, data centers investment, and so on. And the question today for financial managers, for portfolio managers, is not really how do we switch from from fossil to renewable energy. It's just how do we get more energy, period, from any source, right? So the discussion has changed a little bit, and there's sort of less momentum a little bit. But this is obviously cyclical, because, I mean, to my understanding, we haven't solved any of these problems. They're only getting worse. So it'll come back, right? Interest will come back. But what I have seen in the last few years is that now I think we have a lot more clarity, like conceptual clarity, and also from the applied case studies that I was mentioning, we now have a better idea on what to do about it. Mm-hmm. Right? So before you would ask questions, you wouldn't understand the difference between biodiversity, an ecosystem service, financial risk exposures. It was all like related terms that you didn't really know how to tease out. And now we have much more clarity on this. And so when a central bank asks you, okay, what do we do about this? You can actually provide a much better answer. And I think that's a real progress.
Mm-hmm. Well, maybe Salome, building up on that, I mean, how do you move from this awareness, this modeling, to bringing that into financial supervision? What is the sequence of events that you're seeing in your bank?
Yeah, exactly. We have to start with awareness raising, right? And capacity building, both within the central banks, because if you don't understand, you cannot supervise and regulate others, right? And it's very important as well among the financial sector. And in case of emerging markets, especially in emerging countries, like supporting financial sector in terms of capacity building and awareness raising is very important. And we try to follow this approach. So we always start with capacity building, awareness raising. Analytics and research is key for awareness raising. Then we move to the policy and regulation, and accompany it with additional guidelines and tools. And this is very key and essential, because based on our experience and from many other emerging countries, telling or requiring banks only what to do is not enough. You also have to support them how to do this. Mm-hmm. So just telling them manage climate-related risks. Now, I guess most of us, or most of the financial sector knows that they need to manage climate-related risks, so more broadly nature-related risks. But then how, right? And this is a big question. And here we try to provide additional guidelines with more detailed requirements, more detailed guidance of how they can do this, as well as tools. Maybe it's not a direct mandate or but a job of central banks to develop these supporting tools, but it's very important and turned out very successful in case of Georgia.
Mm-hmm. Thanks.
No. I just wanted to answer also to CDP. So first to thank CDP, because CDP was among the first ones back 10 years ago to discuss also with the big water users and to flag the risk. And so the risk was there, but the risk has increased. What we see when we discuss with clients is that many of them are aware. We are discussing with large regions that are considering, that are looking into efficiency, reuse, and desal as a backup to ensure continuous water supply. We are discussing now with data center. Before in conferences, the big ones were there, but it was more about good corporate behavior. Now it's not that. When I discuss with them, water is more important than energy very often. Water is a big issue because it's a shared common good. And so the decision of implementing a data center depends on water, and they are aware of it. And now we start discussing also with banks who are coming to us. They are doing their own analysis of their water risk of their own loan books, and they come to us because they want to become water resilient and to go to their clients and for them to invest in water. So their portfolio is becoming water resilient, and that is new. And I think they do that because the paradigm is also changing. It's good to say that there is a risk, but there are also all the big ones they understood that water availability and water security will become a competitive advantage, not only a risk, so it will be something positive. You will know that this data center will have no problem because it has water, it did those things right.
Mm-hmm. Great, thank you. Yeah. Okay. Well, we'll have one more question in the room and then we'll turn to the online.
Thank you so much. I wanted to just, it's not a long two questions, but combined on the same topic of the sovereign element here. So I guess on the first thing, which all the speakers really articulated, is that ultimately and as part of the central banks, you're talking about supply shocks.
Sorry, could you please introduce yourself?
Thomas from Aviva, the insurance company. Is talking about this from a supply shock framing, and arguably in the last 4 years we've seen, or 5 years, 2 very prominent supply shocks in the energy market, and we've seen almost a reaction in terms of the monetary policy stance and the implications. But kind of underpinning that, which relates to water, is when we talk about basic commodities, price sensitivity is really acute. So the ability of these supply shocks to feed through one-to-one to direct increases in price, particularly the direct first round, is kind of limited, particularly for water, which is a highly regulated system. You wouldn't necessarily get that uplift. So it'll be interesting to hear views on what we've seen from the energy side, is that governments have had to subsidize the price, so that hits fiscal balance sheets first and thereby sovereign debt before you might have an inflationary impact necessarily as a first round. And then second, drawing on that, the parallels with the energy market. Now the energy market, if you use that as a proxy for climate change and, not just climate change, but the kind of the source, that's a highly liberated market. That's a lot of private firms. So when you're looking at financial institutions, when they identify the risk and how they manage, one is via stewardships with corporates or via the energy sector. It'd be interesting to hear views for the water sector, because obviously naturally that's largely public ownership, it's largely regulated. So for investors, that would arguably lead to a lot of or more designated engagement with sovereigns, particularly in terms of big plans of reservoirs, infrastructure. So it'd be interesting to hear, given some of the analysis and the implications it would have for financial institutions about identifying and managing such risks, that has a very different interplay to climate and energy, in my view, but it'd be interesting to hear the panel's views.
Thanks. Maybe I'd like to ask Irene that question, because effectively, I mean, I understand that in Costa Rica, there's a lot of interaction between financial regulators and policy makers, because you're right to say, in some way, the water market is not really a market. It's very rigid, and so therefore there's not the same price responsiveness. The price signals are not functioning to signal scarcity, because we need to change the institution. So that goes back to, what do we do with this? And I think you have experience in this area in Costa Rica that you could share with us.
Yes, so in terms of water for personal consumption or domestic consumption, in Costa Rica, the main source of water is public. However, a lot of households and some even enterprises, specifically in regional areas, are using water from their own wells. And in many of these cases, these are not regulated. So our main water supply company, it's making sure that it provides water for the great metropolitan area and some other specific regions of the country. But many people are not relying on these water sources, let's say, but they have their own, and in most cases, they are not highly regulated. In terms of how we reflect, well, and water prices are fairly low in Costa Rica. This is one of the main results that we see even from the water accounts. Even though there are big losses from the moment that you extract the water to the moment that they reach your faucet, let's say, at home, it's expected that the loss of water is around 60%. And this has been accounted for from 2016 onwards. However, the cost of water in Costa Rica for 1 liter, it's more or less $1. This is how much it charges you at home. So it's even more expensive to go and buy the liter of water in a supermarket than whatever you will find at home. In terms of energy prices, as I was saying, the regulation of energy prices in Costa Rica is conducted by ARECEP. And particularly, as I was mentioning before, when we see a reduction of the levels of water in our reservoirs due to extended dry season, what happens is that we have to use other kind of energy sources. We do have solar energy and wind energy. However, these are still representing a very short amount of the whole electricity matrix. So when combustion needs to be used in order to put into execution the thermal energy, our energy bill goes higher. However, just to give you an example, I was mentioning before that we experienced a very strong El Niño and end of 2023, beginning of 2024. We are already in almost mid-2026, and we, as consumers, have still not been affected by the increase in costs of thermal production, mostly because of political reasons that this has been ongoing and postponed, but anytime now we are expecting for our electricity bill to go up. So it has also macro implication in terms of major IED companies located in Costa Rica being affected by all of a sudden rises in electricity bills.
Mm-hmm. So the price signals might not always work, but the risk to business continuity that Edouard was mentioning might be the strongest sort of trigger, no, in some cases. So we'll turn to the online questions. Is it you, Laila, who?
So we have a few questions online. I'll ask one from James Dalton from IUCN. So better disclosure, pricing and scenario analysis matter, but they do not by themselves fix weak governance. Underpriced water, etc. So what are the translation layers between hydrological stress to prudential metrics? Maybe I'll ask one more as well. How do you see the collaboration between the finance actors, especially banks, and various representatives of the water sector itself, e.g. water utilities, ministries of water, river basin organizations, to help channel investments into water management and also to manage water-related risks?
Yeah, maybe, Edouard, do you want to answer that question?
The second,
the second question, because we're running out of it.
Very quickly, actually, the financial sector is also part of the solution. We are working a lot with banks, and it's a way we are providing intermediate lending to banks. So, and then they on-lend smaller, they make smaller loans to utilities, and SMEs. So they're already part of the solution, and they're already our partners.
Mm-hmm. And anybody would like to answer the first question?
I may take the first question. That's why our approach is broad, and we not only do the research and analytics to understand what risk we are facing, but it's linked to the policy and regulation. And the governance is a key, right? If financial institutions don't have a proper governance in place, yeah, we won't see the real results on the ground. So one of the first things that we did was we introduced ESG, and in our case, ESG includes climate. ESG-related provisions in the corporate governance code. And mandate financial institutions to integrate ESG risk into their risk management frameworks, do ESG disclosure, but the governance requirement is at the supervisory level. So supervisory board should be in charge of making sure that this is done properly. So this is how we address this topic. So through the governance, because it's key.
Mm-hmm. Thank you. Well, we're getting to the end of the session, so I'd like to circle back to you, Elias, who opened the discussion in terms of, we talked a lot about the need to collaborate across central banks, so that's what we're doing, and it's what the NGFS is doing. So what would be your call to action to the room? We heard from Mathilde about, the interest in having something that we could put forward to the UN conference. Soledad Núñez was very supportive of that. How is NGFS positioning or seeing this as what can be done from an international perspective as well?
Yeah, so I guess I would go back to the point that nature and climate risks are not over. They will become, if anything, more serious as we go forward. But in the meantime, the NGFS and other institutions have been advancing the intellectual work, and today we can provide a lot more answers and provide more clarity on how central banks and regulators can start addressing these important issues. So I guess that would be my call. We're here waiting for you guys, and so please reach out, hopefully soon.
Great. Well, thank you. Yeah, and then we have, today, tomorrow to share more about methods and approaches and how we can take that into action as well. With a reminder that the last session tomorrow, session 7, we will be bringing together key findings, key tension points from all of the sessions that we're having, and we'll have an open space for discussion, because as Mathilde also mentioned, one of our objective as the OECD is to produce a policy paper, a set of recommendations at national level, at international level, in terms of how this debate can be taken forward. Obviously, it needs to be, as you said, for Georgia, on a national level, the central bank, the financial institutions, the policymakers, etc., have to work together in order to advance on these topics. And then there's a need for broader collaboration through the NGFS and others. So hold these thoughts, because we expect you to come ready with, brimming with ideas tomorrow morning, so that we can take that into a productive set of recommendations. Thank you very much for your attention.
Thank you.
Hello. It's just a coffee break time, so we come back in 30 minutes. mostrar. Well, we're going to start this second session. Thank you very much, the previous speaker, for a very rich discussion. Many messages, water-related shocks are already visible in macroeconomics, including inflation and economic growth. These risks interact with climate and natural risk in ways that amplify uncertainty, creating many tensions that translating through the multitude of transition channels. And they raise difficulty questions for policy frameworks that were not designing with water in mind. In addition, the substantial importance of water when we are talking about resilience or when we are talking about competitiveness. But now, we are going to discuss in the real world, the sectoral impact of all these things, and with that in mind, I'm pleased to give the floor to Joe Ray from CDP. Joe.
Thank you, Juan Carlos, and thank you for hosting us in this exceptionally beautiful venue. I hope everybody enjoyed their coffee break. Welcome back. We heard this morning about the importance of getting to grips with the real economy and the real economy shocks and the transmission mechanisms through which those shocks translate into material, financial, and ultimately financial stability risk. So in this next panel, we're going to be really drilling down from that real economy perspective and asking, where are these real economy risks materializing? What are the most important transmission channels for that risk, both across the real economy and vertically, ultimately up into the financial system? And also, most importantly, a little bit of a solution emphasis here. What is it that governments, companies, financial institutions can and can't do to mitigate these risks and build resilience? A few quick points that I wanted to highlight from recent CDP data, which I think are pertinent just for setting the scene for today's discussion. And the first of these is to reiterate what Nicola said this morning about new LSE analysis of CDP data, which found that when you use real company data to estimate sector-level risk exposure, rather than just using that sector-level estimation as a proxy for water dependency and risk, the risk actually looks larger. So in other words, the models that we have, wonderful though they are in fact, it seems, underestimating the reality of dependency and by extension risk. And what I also found very striking from that analysis is that, and this is hot off the press, I mean, I think it was just yesterday that the report on this was finalized, so very topical and timely, the variation within sectors is really significant. So some companies may be in a highly water dependent sector, but have much more substantial mitigation and resilience measures in place. Other companies may be much more exposed, and there's real variation within sectors as well. So I think both of these findings just point to the need for granular company-level data, and also, I think that's a topic that we will all be diving into over the course of the next hour or so. One final data point that I think is relevant here from the CDP 2025 data set. Supply chain visibility for companies is improving, but it's still inadequate. So on the improvement front, we've seen an increase from 70 to 78% year on year between 2024 and 25. of companies telling CDP when they disclose on water that they map their supply chains. Now that's really important. We think that that 8% increase is quite significant, but of those 78% who say, yes, we map our supply chains, or we are planning to map our supply chains, 3/4 are only mapping their direct suppliers. And as we all know, if your direct supplier is a contractor or an intermediary who is then sourcing from a region of very high water dependency, water stress, then you lack that visibility as a company. So I think the supply chain angle is something that we're going to have to come back to a few times, because it's really critical as one of those transmission mechanisms through which shocks can become financial stability considerations. The other way of looking at that, of course, is that 1 in 5 companies are not mapping their supply chains. And it does beg the question of, well, how exposed are some companies that just lack that knowledge, perhaps lack the capacity, the understanding of their level of water risk exposure. And final point on this is to remember that these stats are from a sample of 10,000 companies, both SMEs and large corporates, who disclosed to CDP on water in 2025. That's still only a subset of the wider economy. So this is, in some respects, a self-selecting sample of the already, let's say, somewhat enlightened on water risk and dependency. And so, again, the reality of broader risk exposure, as the models suggest, is potentially really, really substantial. So lots to get into here. The good news is we have another stellar panel who are going to help us unpack and make sense of all of this. Joining us online, welcome Yuvan. I hope you can hear us well. Yuvan Bejadur is Senior Advisor to the Secretary General of the World Trade Organization. Amy Laws is Head of Sustainability Science and Innovation at Microsoft. Eduardo Nally heads the Water and Sanitation Department at BNDES, Brazil's main development bank. Concepcion Marcuelo Olone is Coordinator of International Water Affairs at the Ministry for the Ecological Transition and the Demographic Challenge here in Spain. And last but certainly not least, we have Andrew Roby, Senior Water Security Advisor at the Foreign, Commonwealth and Development Office of the UK. Final housekeeping note, this session is being recorded, so what you say will be on the record. Welcome to those of you joining us online. I'm going to throw a question at each of our panelists. I'm going to invite them to take about 4 minutes or so to answer. Then we'll move into a more interactive conversation with another round of questions, and rest assured you will also have your opportunity to get stuck into the conversation. We'd like to open this out to the room towards the end. So, Andy, if I may, I'll come to you first. You're behind one of the UK government's flagship water programs, and I think one of the great novelties, if I may say, of that program is the emphasis on supply chains and the need to build water security and resilience using supply chains as a leverage, as an entry point. Can you tell us a bit more about the thinking behind that work and why, in particular, supply chains are such an important consideration?
Thanks, Joe. And great to be here. And I just wanted to give a shout out to Kate Lamb, who's lurking behind, who was one of the other instigators of this Fair Water Footprint initiative. I guess I came into this water business from a very different start point, which was forestry and timber and illegal logging, some work in Indonesia, using supply chains and demand to make a big difference. And we did make a big difference. It took 15 years of my life to do that, including 9 years in country. And I think that was part of the inspiration for this supply chain approach on water. But of course, water is very different from timber. It moves, and this concept of virtual water, water that's embedded in something, I think the easiest equivalent to that is carbon, and the way carbon is embedded into products. So the classic one of a cup of coffee being 200 liters of water, all through the supply chain, consumed to make that product. But we called it fair because it's got to be just, it's got to be equitable, what we're doing. It's not just about a flow of products into a marketplace at a decent price. And that's really important. And I wanted to come back to that at the end of this, because I think we mustn't lose sight of justice in this very unjust world. And the way that results, in this case, people not having enough water, moving and becoming a migration issue, and then a source of instability. So let's not forget that source of instability that then impacts markets and economies, as we know from the Straits of Hormuz and the Iran war. So we formed the Glasgow Fair Water Footprints in COP26 It is a partnership, and that's what we're hoping to come from this room, I think, a partnership on central banks. But for us, it was a partnership of businesses, government, and civil society, supported by academics to identify, disclose, collectively manage water in supply chains. So we've started that work a couple of years ago, and we've deepened that understanding. And maybe some central banks could join us. We would love to have them. And where we found awareness greatest has been in the food sector, naturally, but also textiles and in mining. And to be honest, I wish we'd looked at services a bit more, things like AI and the energy side. But we are where we are. So certainly fresh fruit and vegetables within the food sector is probably one of the most aware bits of the food supply chain, where we've got scarcity, flooding, and pollution. And often it's groundwater that's been the source of water, and that's gone. It's been under-regulated. In fact, there is an issue here about illegal water abstraction. And does your business want to be associated with that in the supply chain? But to get blueberries in our yogurts in the UK, we depend very heavily on water-scarce parts of the world, like Spain. We source a lot from Spain and Morocco and Peru. 78% of our imports of fruit and vegetables come from water-scarce countries. So we've got a national food security issue with climate change making man's management worse. And we've seen that with Morocco. We didn't have enough tomatoes last year because of some floods and droughts in Morocco. Then on to textiles. We've looked at Bangladesh, where there's a lot of awareness of the issues of water because, again, groundwater has disappeared at a rate of meters per year. That was the source. And, of course, the pollution that's come from the textiles industry there has been great. And then mining, naturally, it splits into two very neatly. The big companies that are generally very concerned about water and have a half-decent water standard. And then the other half of our supplies that come from artisanal sources and are pretty much uncharted. And so for awareness, there's good awareness in those areas. We've had engagement with supermarkets and now with growers, and I think there's a lot of work to be done. And yes, there is action happening in the Suez Massa in Morocco, where they basically ran out of groundwater a few years ago, and they have a great big dam up the front. We are doing some collective action work, and I think this is a key thing to come to. Individual farmers can't solve this problem, neither can retailers or anybody else in the supply chain. It needs a collective action approach. And have we got the tools to do that? Water stewardship standard at the moment does not have a collective action standard. Very few of the standards in agriculture have a collective action element. And in fact, this is something that we hope to be working on going forward. Thanks, Joe.
Wonderful. Thank you, Andy. And I may come back to you on the collective action piece, because collective action sounds great in theory, but which actors are acting where and under what incentives are the key questions for that. And I know that's something the water stewardship community are really wrestling with, but is there a way that we can bring financial sector actors into these collective action initiatives that have been corporate-led and implemented so far? Concita, maybe I can come to you and just continuing on the supply chain theme that Andy referenced. So from the Spanish government's perspective, what do you see as the main disruptions when it comes to water? And in particular, what are the implications for supply chains that are actually rooted here in Spain but have implications elsewhere?
I will. I'm a bit new in this sort of debate of try to bridge the gap between the water dialogues and the financial dialogues. So I am an engineer, always working with water, so I hope to provide something useful here. For this first round, and regarding your question, I think that, well, as a main idea, I would like to share that we have Spain. I think that we can say that we have a solid institutional and technical base in the field of water resources management. And we think that the real challenge is no longer to identify the risk or no longer to put all the efforts in identifying the risk, but to execute the investments and transformations required by the new ecosystem, my new climate-related reality with sufficient speed at an adequate scale. I will provide some 3 messages. My director always says that smart people give their main ideas in 3 messages. I will do the same. As message first, I would like to share that Spain is based on robust water governance, and I think that robust water governance is key for bridging the gap in providing more water to more, or to providing water to all people. So as I said before, we have a consolidated framework. Technically, I could say technically advanced hydrological planning or water resources management planning, and a good institutional framework based on water management at river basin scale, and depending on the ministry, on our Directorate General. And this planning process allocates water. Our legal framework commits to the planning process to allocate water to the socioeconomic sectors. No? So in connection with the economy and the supply chain, our legal framework attributes to hydrological planning the responsibility of making water allocation under different scenarios, levels of warranties, and reliability of supply. And this decision respect a precondition of to keep the ecological flows according to the standards. The standards issues is very important as well, and also the treaties with the neighbor countries, in particular with Portugal. And this hydrological planning, I think it is worthwhile to say that is integrated into risk management in draft risk management plans and flood risk management plans. So in this part, okay, we are good. But now disruption are already there, they have a cascading effect. So we have an increased frequency and an intensity of droughts and floods that we are suffering as water resources managers. And climate change is impacting the way that we have to manage the water cycle. And it's been transforming the way that water has to be allocated to the different sectors. So, and it's not only in when we say it's in the water-stressed basins. No, I will provide you with an example. For instance, the drought of the 2023, which impacted many areas of Spain, but in the Ebro Basin, which is northeast of Spain, is not water-scarce country, a water-scarce basin, but it has a real impact, a very important impact in the sectoral allocation and in the water management. So this drought was a warning sign of the water stress creating effects on irrigation, energy, supply, the local economy in general. And after the end of the hydrological year in October 2024, and after the rainfalls of that, the end of the year, there was only 5% of the total capacity in our reservoirs. So there were still 3.5 million people in municipalities in emergency situation, and some 100,000 people suffering from cuts of supply, problems due to lack of infrastructure reliance. So we also found out that the relevance of communication and transparency with users, institutional coordination, and the involvement of the affected sectors, the people who were directly affected, was highlighted as important to be more reliant and to make more reliance. It's not only infrastructural problems, but also a question of better governance problem as well. And as the third message, and it will be linked, I hope to be linked to the second round of question, is the most, I think, underestimated risk or not, but it's the gap between planning and execution, the investment execution. So in this planning cycle from 2022 to 2027, we have a lot of measures, more than 6,000 measures for achieving the objectives of the planning process. We have a planned investment, huge plan, investment of more than 20 billion euros, but the problem is that there is a low execution of these investments along the cycle. And this is joined that the assessments that we have received recently say that we have a gap of investment of more than 100 billion euros in the next decade. So this is real, a real issue, a real gap that increases the exposure of critical infrastructures, such as our dams and drainage systems, and amplifies the economic and territorial impact. So for the moment, I will share more afterwards.
Wonderful. Thank you, Conchita. And I think that hosting this whole conversation in a country that is, on the one hand, extremely advanced in its understanding and planning for risk mitigation and resilience building, I think it's wonderful. And at the same time, we're confronted with the reality that such an advanced economy with such advanced measures in place is nevertheless vulnerable to hydrological shocks, both in terms of floods and droughts and extreme weather events. And so, yeah, thank you for setting out the Spanish government's position on that. We haven't yet spoken much about major industrial water users who are such key players in this whole conversation and who are increasingly both understanding their water risks, but also increasingly visible and in some respects in the firing line in terms of public perception and policy perception as well. Amy, you're Head of Sustainability, Science and Innovation at Microsoft, and so you no doubt hear the words data centers and water use many times every day. Thank you for joining us. What I'd really like to ask here is, how does the obvious dependency that a major tech company like Microsoft has on water, particularly from that data center perspective, how does awareness of that dependency influence the investment decisions, the CapEx decisions, the asset locating decisions that a company like Microsoft makes?
Great, thanks, Joe, and thanks for having me. Great discussion. So water is a critical issue for Microsoft and the tech company, as it is for really all sectors of the world, and is becoming an increasingly important issue, both because of the growth of our industry and our sector, but also because we recognize that water is becoming an increasingly big stress around the world. So in terms of how we think about where and how we invest in water in the context of these changes, I'd break it down into three areas. One is in the context of what we do in the data center. The other is what we do in the context of where data centers we operate data centers. And the third is our supply chain. So let me start with the operations within data centers. And this is really a lot about innovation, and there's been a tremendous change over the last decade in this space. For example, our most recent data center design are essentially zero water cooling, and cooling is the vast majority of the water used in data centers, virtually all of it. And so right now, data centers, it's really a design choice for us whether we use water or not, and where would be appropriate to do so. In the context of where we operate, and that's a different issue, right? So as we said, and as this group certainly knows, water scarcity is becoming an incredible stress in many places in the world, and including where data centers are operating. And that's why we're really investing in focusing on developing water-positive growth. Now, in 2020, Microsoft actually made a commitment to become water-positive enterprise-wide. So at an enterprise-wide level, we would replenish more water than we use. And recently, and in part because of the expansion of AI and the rapid infrastructure growth, have recognized that we need to not just think about that from a corp-wide level, but we have to think about that really in locations where we operate. Now, we always did this in the context of, in the corp-wide level, we focused on replenishing in the most water-stressed regions in the world. that were informed by where we operate, but not necessarily tied exactly to where we operate. And now, in January, we launched what we call the Community First Infrastructure Initiative. And with that, what we're really doing is focusing on, okay, let's go to those communities where we operate, where we didn't see as much of a problem in resources early on when we were smaller, and understand what are the challenges and what are the opportunities for us to be able to be resource positive in those regions. So in water, what that means is a real increasing focus on replenishment projects that go specifically to the municipal water source. Because most data centers actually draw water, not all, but most data centers draw water from municipal water sources. And so the issue in terms of water that's used at data centers for cooling is, well, if we're taking it from there, what can we do to improve and reduce the water, save water, add water to those water systems? Sometimes that includes investing in recycled water, improving access and increasing access to recycled water. But increasingly, we're also focusing on addressing and reducing water leaks. So, for example, we work with a number of companies. One example is with Phytotech, which is a company that uses AI to use acoustics to find where the biggest water leaks are, and then help direct investments to address those leaks. And this is an important context to think about. So take Phoenix, for example. In Phoenix, if you do a rough estimate of all the data centers in Phoenix, and you look at how much water they use for cooling in the data centers and compare it to water leaks, it turns out it's about 6% of the water that is lost in a year in water leaks in the city. So if you had a system where all the data centers and really all the companies that come in had to invest in just solving those leaks and had a system where we could do that in a coordinated way, it's pretty easy to imagine that from an operational standpoint, from the municipal water system, we could be a net positive as an industry and as a community, as businesses going in. So thinking about those structures, I think, is really important. Now let me turn to the supply chain. And for the supply chain, for the tech sector, of course, there are two areas, chips and energy. And for energy, we all have that problem, right? Unfortunately, still, most of the energy systems in the world are very water intensive. And so whenever you turn on your lights, whenever you use energy in the electricity system, we are drawing water. And that's something that, of course, we can change in the context of moving for renewables, and that's certainly an area that we're investing in, but is a broader systemic challenge for the whole society and a reason for us to be investing beyond just climate in renewable energy. And in chips, the issue is innovation, again, in terms of coming back to what I was saying, one of the things that was driving us internal to our industry. There has been a lot of innovation in this space. There is an increasing amount of circularity in water systems. Chips do need pure water, so that adds a complexity to this. But I think there's a lot of advances that are happening, and there can be incentives and drivers to do more than that. And the one other addition I would add to this, because I think that there's, as you say, there is a lot of attention on this area, is this distinction between the water in the municipal, solving the water in the municipal and solving the water in non-municipal areas. Now, of course, I'm trained as a hydrologist originally, so I understand that these are all connected. But when you think of the problems in these different peaks and in the timelines of the challenges of the watershed problem and the local problem, the hyperlocal problem, I think this distinction of the challenge, how you're addressing a challenge is from the municipal and the watershed is really important, and something that we're really focused on now as we think about and begin to address water and other resource issues from this sort of community-first space approach.
Thanks, Amy. Some really interesting reflections there, and a few things that we can follow up on, particularly on the supply chain piece, because you're right that obviously zero water is now an option. It's a technical option for cooling, but it's not an option for energy generation and chip manufacturing, right? So arguably the dependencies are greater upstream than they are necessarily on the cooling front, but it's cooling that is easy to understand and which can be picked up by the media and which has helped to generate so much momentum and attention around data center water footprints. So really interesting reflections there, thank you. I actually want to bring in Eduardo here and then Yuvan, will come to you directly afterwards. But Eduardo, just staying with the investment theme. So you represent Brazil's main development bank. Just interested to see from your perspective, sort of what are you seeing on the ground when it comes to financing projects and initiatives in Brazil, which are critical for economic growth and resilience, but have a high water impact and dependency? And any reflections you want to share from your direct experience at country level?
Thank you, Joe. First of all, I would like to thank for the invite. I'm very glad to be here and be part of such an important discussion. I'll try to focus on Brazil and what BNDES is doing. BNDES, the major development bank in Brazil. Look, the Brazilian economy is highly dependent on water. Every economy is, but especially Brazil, because of our hydropower generation, our strong agriculture, our industry, our big cities, and a relevant part of our infrastructure also. So what's changing is that water is no longer only an environmental issue. Now water is about financial risks. When you look to the past, a few years ago, and you talk to a company, water risks for them, and for the banks also, for BNDES also, was only a reputational risk. So talking about water risks was just a beautiful speech. Now things have changed. So it's about resilience, it's about adaptation, it's about continuity, it's about profitability. So things have changed in Brazil. For example, in agriculture, you are concerned about the changes of rainfall patterns and droughts. On power generation, also droughts, and if the system is resilient in case of a long and severe drought. We are concerned about the competition between industry use of water and the human consumption that obviously is priority. So what BNDES is doing is changing the way we analyze the project. So of course the financial issues are important, the traditional financial issues are important, but we added in our analysis some water-related risks and climate change risks. So we analyze where the projects are inserted, where the companies are inserted, if the project or the company faces any kind of vulnerability in this theme, the intense use of the water, and for that we use two major tools in the bank. One georeferential tools that identifies where the project is, in which ecosystem it's inserted, in order to see if it's in any kind of sensitive area, for example, Ramsar areas. And the other one is Adapta Brasil. Adapta Brasil is a tool developed by the Brazilian Ministry of Science, Technology and Innovation that projects climate change impacts in all the cities, municipalities in Brazil up to 2050, sorry. So it's not about the present anymore, it's about the future. And BNDES also analyzes the capacity of the companies to identify and mitigate these water-related risks. And if we identify that the company doesn't have the capacity to manage, we try to build a solution together. So what we see now in Brazil is that companies finally understand the issue, they agree to find solutions, and they are willing to build solutions with us.
Wonderful. Thank you, Eduardo. And I think it's just interesting to hear you talk about water being treated as a resilience and adaptation issue, and what was once corporate social responsibility sort of framing, and as you say, a nice speech to make with polite applause at the end is now a much more material and integral issue to some very important economic conversations, not least the one we're having today. I want to just take this up one level to the trade system, because of course supply chains don't exist in a vacuum. They are influenced by and have influence on trade routes globally and interact with trade policy, which of course is in turn heavily influenced by geopolitical change, geopolitical rupture even. Yuvan, first question to you is, do you hear us well?
I can hear you well.
Excellent. Second question to you, Yuvan. You have a front row seat to some of the trade disruption and challenges, but also opportunities that our current sort of geopolitical climate is creating. I'm interested to know, from the World Trade Organization perspective and from your very unique vantage point there, where are the most consequential pressure points when it comes to water? And just to contextualize that a little bit, Prisoners of Geography is on all the bestseller lists again now, and you can pick it up in any airport you go through. Geography is back in vogue, and we're all acutely aware of the pressure points in the global energy markets. Very interested in your take on any water parallels, some of which may be increasingly well understood, but others of which may still be flying under the radar.
Great. Thank you so much, Joe. And let me first thank the OECD, Lila Davis, my colleague, the Bank of Spain, for organizing this wonderful session, and the CDP, of course. Joe, thank you very much. And my apologies for not being able to be with you, and even more, my apologies to have a larger Claude Monet painting instead of the beautiful Goya and Picasso paintings in the Bank of Spain, but that was not intended. Happy International Tea Day as well. I mean, one single cup of black tea, because of the growing, the processing, the brewing, requires 30 liters of water. So I just wanted to put that as a small point to kick off the conversation. But I think, Joe, one of the key issues we're seeing is that right now, industrial policy, the industrial policy wave that we're seeing is creating a concentration risk that will surely land on the sovereign balance sheets of central banks. We've seen from the G7 to the G20, all the major industrial countries, industrialized nations, are running an industrial policy which is designed to really onshore industries of the future. Semiconductors, critical minerals, AI infrastructure, clean energy, and you name it. The CHIPS Act of the US, but also friendshoring mandates that we're seeing and strategies are really, in a way, dressed a bit in the language of national security, and some more, some less. But what does that really mean? I mean, I think that what really means now, especially now, considering also the impacts of the Strait of Hormuz closure, is that you're going to see much more of the trade being reconfigured and being rerouted with new shipping lanes and new trade routes. And that's already happening. You're seeing more pressure from Hormuz, which is blocked, to other choke points, whether it be Malacca, whether it be the Sea of, the different seas that we know, Malacca, Bourbon. What does that mean? That means, I think, that the semiconductors that we are seeing, that the fertilizers that are being produced, the manufactured goods that still use water, and oftentimes in water-stressed areas and hubs and global markets, are not necessarily being factored into these analysis and those analytics. We know, for example, that from some of the work that we're doing, that in a price average of 90 barrels a barrel this year, we forecast that merchandise trade will slow to 4.1%. And that in 2027, the figures will be 2.8% and 5.2% respectively. So my point is that as these pressure points increase, as those dependencies move from place to place, central bankers and central banks, who have often been extremely helpful. I mean, I remember my time at the World Bank, where we worked very closely with ministries of finance and central banks to really look at the price of carbon, to really look at carbon emissions, to look at financing mechanism instruments for forestry. But we haven't really looked at it as much, I would say, for water. And we know that this transition, and oftentimes it's taken 10 years or more to make that transition to a green economy and to really looking at water as a macro critical issue, will have huge financial costs on the economy, will have implications for jobs and for development. So where are those points? I think one of them is, as I mentioned, is this wave of industrial policy, which is really creating water concentration risks. And it's not just water which is concentrated. The financial system is over-concentrated in some ways. Critical supply chains are very concentrated as well. So I think there's a need to really see how we deconcentrate these. How do you look for water in places which are more abundant? Because I think Andrew mentioned it, a lot of the developed countries are pulling the resources from where it's really scarce, whether it be the vegetables you're using, the cotton that are being produced, the fashion industry, etc. So I think that's one key thing we need to really look at. The second point I would say is that water is totally underpriced. One of the key messages that came out of the Global Commission on the New Economics of Water, which Dr. Ngozi, my boss, co-chaired alongside Mariana Mazzucato, Johan Rockström, and President Thurman of Singapore, was to show that water is not only a global public good, but it's also vastly underpriced. And I think central bankers are extremely well placed to look at the issues that are very relevant to that, whether it be inflation, whether it be unemployment that might come in the future, whether it be macroeconomic instability, and how do you ensure that the configuration we can build for the future, the models that central bankers build for the future, really look at more stress water tests, really look at the NGFS scenario architecture and look at it from a very robust way, a very ecosystem way. The prudential capital assessments that some of you guys are doing is not seen as a sensitivity, but as a core variable. So let me just give these 2 points. So water as underpriced, and the choke points that we're seeing only requires us, and I'll mention that in the next few points when we talk about it, is how can the trading system really be a cushion for more trade resilience for those choke points of the future? Because I think a reformed trading system can really help in some of these areas. Thank you.
Thank you, Yvonne. Lots to get into there, some really interesting reflections. I think that point that trade is not neutral. When it comes to water security and resilience, it is either advantageous or disadvantageous, or in most cases a combination of the two. But as we see this trade flow realignment, which is being driven by geopolitical change, the impacts will not be neutral. My fear, particularly as somebody sort of trained in political science and international relations, is that actually in many security and trade policy forums and arenas, the environment more broadly and water as part of that is at risk of being subordinated to shorter-term strategic security concerns. And I think that is something that those of us who care about and understand the implications of water risk and dependency for macro criticality need to continue to make the case for. So some really interesting reflections there. Thank you, Yvonne. I wonder, Andy, if I could come back to you and just sort of moving the conversation on towards a bit more of a solution emphasis. Fair water footprints, as part of the broader Just Transitions for Water Security program that FCDO is running, is an attempt to address some of these unsustainable trade footprints from the perspective of a sort of enlightened self-interest. It's not traditional development programming of the sort where you are out, in a developing country necessarily just seeking, development as an end in itself, but there is also a quite sort of hard-headed, almost national security-oriented, self-interested supply chain resilience lens that can be applied. Is that something that you could speak a little bit further to? Also keeping in mind that the UK National Security Council has released recently a review of our dependency on supply chains, which in turn depend on ecosystem services.
And that's a really good place to start, that UK awareness of the national security risk of nature loss. And that report, as you rightly said, came out in March and identified very clearly that Yeah, our defence, the defence of the realm, the prime responsibility of government was actually being undermined by nature loss, not just in the UK, but particularly through food supply chains in other countries. So we have this collective responsibility, this collective challenge. And just thinking about what Yuvan was saying about trade, I think there's a role here for something close to the things like the carbon border adjustment mechanism for water. This is perhaps a bit of a jump, but if you're looking at how water is included in trade at the moment, it doesn't exist in any of the trade agreements that I've looked at. And yet it's fundamental to the sustainability of that trade agreement because we're looking at materials, and it could be just metals and chips. We're all very into those at the moment going forward, but it will be increasingly food and other dependencies. Where is the water scarcity included in that? And so chapters in trade agreements. And we can start small with this. And just to come to a couple of countries where we're working, Malawi and Morocco, two very different countries, but both water scarce, both very vulnerable, one with very poor sort of high poverty levels, Morocco much, much better off. The program that we've developed around fair water footprints, one element of it is national policy, is looking at resilience and national policy lens, coming in through national adaptation plans and the UNFCCC. John Matthews is here in the room, who's led the Water Resilience Tracker. When you get national policy right, that should be steering how investments are made, and actually what central banks do, and what treasuries do, and all the departments. The issue we've had is that water's been siloed into an infrastructure project rather than taking the environmental broader view of things. So we're helping Morocco and Malawi do that, Brazil too, there's a number of other countries. And then at the other end, you've got, how's the investment going to happen? And the last 3 days here in Spain, you've been looking at this. And again, we've very much focused on water utilities, a supply service issue, whereas we've not been dealing with the nature crisis, which is ultimately going to undermine all of our supplies for whatever source you're talking about. And how are we going to, those benefits, those flows of benefits that we all perceive but don't pay for. These are not just a pricing of water issue, it's a pricing of all the other environmental services that we derive because water is there. We have to be smart and start to create some new markets, as we've done for carbon. Carbon is ultimately something that you and I don't pay for, right, as individuals, but we are now paying for it in all sorts of different ways, in the way that we're investing in renewables, for instance, and things like that. So I'm looking at this long term, and you're right, Joe. At the moment, governments are very short term, and we're looking at, and the political cycle doesn't help. We're on 3 to 5 year political cycles, sometimes less in our case, where you get a change of government all of a sudden and a change of direction. But undermining most of this is the fact that we use discounted cash flow for our economic calculations, which discounts the future. We need to have another look at this. I know I go on about this at every opportunity, but we are using the wrong economic tools to assess investment publicly. And I think that runs through the boardroom into the way that our businesses operate.
But is there, I mean, just to make this very practical and concrete and taking advantage of the folks we have in the room, is there any particular sort of call to action that you would want to sort of put out today in terms of that collective action piece and moving beyond, just a few front runners working on this, but actually something broader and more collective?
I think signals that come from central banks are obviously something that finance directors and chief executives look at very closely. So when the governor of a bank, central bank, says, for instance, that climate change is a soft risk, that sends a signal that we don't really care. We must be aware that that language is picked up and converted into investment decisions. So it's getting that language aligned. And I know this network of green financial systems is looking at that alignment, and I'm looking to that to create some signals, governors speaking collectively. We are, for our sins, presiding over the G20 next year, and we're wondering whether nature and water has something that we can do together as the G20 on this. We're not sure, but it would be great. If we had a signal from the governors of the NGFS banks, that would be very powerful.
Just in terms of signals and that corporate policy interface, Amy, perhaps I can bring you back in here. I think we all know that the private sector moves at a speed that policy is rarely able to match. I think that's a given. From the perspective of a major tech player that is at the forefront of so much cutting-edge innovation and investment and capex and water dependency and is really a system player at this point, are there sort of one or two calls to action that you would make for policymakers, financial regulators, in terms of helping to bridge some of the gaps between where the corporate world is now when it comes to water risk and dependency and the state of our current regulation and policy?
So I think that the biggest challenges that constrain corporate's ability to move to this water positive approach that I think that is possible is one is data, and this is something that the water community certainly understands as a challenge, but it's interesting because I'm very aware of this in the context of trying to think about what is the water context of and ecosystem context. It's something that my team's really focused on, of all the different places we work on, to really to understand what is happening and what can we do and what is a new development going to mean in that region. And it's so interesting because there's a real push for data centers to disclose, and we have committed to do that in a much more granular way, which will be coming out soon as a part of our Community First initiative. But the interesting thing is it's incredibly hard to get information about water from any industry and any sector to just put this in context. And I think that is a really important thing to understand where a company is coming into, like who are our collaborators in this space working in the basin, and what are they doing, and how can we connect with them? The other part of data, of course, is also understanding the risks in that region. I think we have arguably, in some ways, a better understanding of those, although not at a level that's never necessarily operational. Which brings me to the second point of areas where I think government and banks, financial institutions too, can help. Is it's very difficult right now to figure out where companies should invest to have the biggest impact and be most positive in a region. And part of that decision is based on the hydrology, the regulation of the place. In some places it's very complicated, right? So you can invest in this area, but because of the regulatory system on the water, it might not have the impact because of constraints. So a lot of time is spent and money is spent trying to figure out what's the best investment, and perceptions in the community is also important and will always remain important. It's science-based targets, science-based investments, right? But it becomes really difficult to find the best place to put funds. And if there could be a system and a structure, and I even really believe that we can set up a system that says, in every municipality, any company that comes in, you have to pay into this fund to address all the leaking pipes, or to do this, to this, and to even out that system and really solve the problems together and just make it easy to do that. And the third area, and it might seem like an odd thing to present in the government and financial systems, but I do think education is important. And it's not so much, I've also worked in water work on climate and ecosystems as well, and but in water for sort of my whole life is, before it was just understanding where does your water come from? Water is important, it's scarce. But I think now, in terms of the type of education that I think is really important, is understanding focusing on what are the problems to solve, right? I sometimes say, you know, we're fighting the wrong fight so often, I see, you know, and it's wasting energy, it's wasting money. And if we could figure out and get people to really focus on these are the areas in these regions, and water, as we know, is a local issue, and that means that in the basins and the sub-basins, we have to be able to understand what are those problems and what are the fights to fight, because I think sometimes now the discussion is missing the solution, and if we focus on instead trying to get together on the solution, we will stop talking past each other in this, you know, emerging and evolving crisis.
No more red herrings. I do have a few follow-up questions for our other panelists, but we've got about 15 minutes left, and I promised participants here would have an opportunity to get stuck in. I see 2 hands, 3 hands already at the back. Do we have a microphone going around? Or not? Give them a moment. Hands up again, please. Yep. Gentleman at the back. Yep. Yes.
Hello. I'm Noel Mary from the IFC, part of the World Bank Group. So I think the gentleman online has mentioned something which is very interesting that we've not touched yet, which is water is underpriced. And I guess the whole fragility of the system is something that we don't mention, but is water tariff. We know they are low, even though we also know, I mean, low tariff hurts the poor, but the whole fragility of the system financially, and the system that is already under stress. So even under bigger stress now is climate change, because investments that were not made and resilience adaptation to the water system and infrastructure is getting even more complicated because the system is already in deficit. So you look at public expenses, they are not enough to increment access and then to get to the SDGs, obviously. I mean, and we're getting way behind. But still, the tariffs are remaining low, and regulators and the governments are still not looking at increasing the tariff, which has then the consequences on supply chain, etc. I mean, we had Irene from Costa Rica this morning. She made a comment like, oh, our energy bill will increase. And it seems like, okay, it will increase, but it's quite normal. But if you say, my water bill will increase, nobody won't even say it. I mean, it's like something we don't want to talk about. And I think it's the crucial element. I mean, really, if the central banks can weigh in to make government adjusting tariffs, so not full cost recovery, which is impossible, of course, but at least to a level where the operators can supply water at a quality and quantity that is necessary, then it will decrease also the risk on the balance sheet of the banks that are lending to the water sector, and also promote more private sector participation and water operators to be more independent, more sustainable. I think it's a key element in the whole big picture. No, it will not resolve everything, but I think it's a fundamental piece that can help.
Yeah, I think we'll take that as a comment, unless there's anyone on the panel who wants to react. I suppose the reality of the political economy of water is such that it will never have a global spot price as in the energy markets, and that's one of these permanent constraints that we all have to live with when it comes to water. Were there any central banks in the room who wanted to respond to that? I don't see any hands going up. Yes, Central Bank of Morocco, if I'm not mistaken.
Thank you. Just to share a concrete example from a developing country, we back in 2022, we've explored with the World Bank climate and development pathway in Morocco, and as a water-stressed country, we have explored the potential of rising the prices to have a fair water price. But the problem is that you have some competing priorities in the social services, education and health. You have the major part of the population which is poor. And if you have a higher price, that would imply that you would lose some of the hardly gains on eradicating poverty. So you need to have some compensatory policies once you consider rising the prices. And it's really within the government's policies' hands that we would stand, because central bank could push for that, but you need to not be in conflict with other SDGs in countries where you have a large population which is actually poor, and you need that all the benefits from rising the prices of water should be translated into social services benefits. And when you look at the whole policy mix, it's quite tricky and complex to really rise the prices of water. Just to share a concrete example, maybe from a more emerging developing country.
Great point. Lady here, yeah.
Good morning, I'm Sarah, I'm from the Central Bank of Brazil. The only point that I would make, adding to your comments, is that water is a universal right issue. So it changed the whole thing. And so that's why most tariffs, they are subsidized in most developing nations. So it's a bit different from energy, I would say, the topic.
Radically different, right? Radically different, and that in part is the problem. We're not going to see investor capital markets price signals for water of the sort that we see around energy scarcity because of water's unique political economy and its role as a human right, indeed. Other questions? I saw there were several hands. Yes, gentleman at the back, you had your hand up first, I believe.
Thanks. Mine's a question to Eduardo, just to warn you, Eduardo. I'm picking up on Brazil. So my name is David Chubb-Jones. I'm head of resilience at the Climate Bonds Initiative, and I wanted to hear a little bit about Brazil and solutions. Partly because I live in Cape Town. I've made that my home for 20-something years. And we got bailed out at day zero in the city of Cape Town by farmers who actually agreed to give up their water and give it to the city. So I heard you talk about BNDES, what you do on water and sanitation. But obviously in Brazil, a lot of what's going on that links to the water cycle is tied up in agriculture, nature as well. So what I'd like to hear is actually internally in your bank, what are the discussions you have with your colleagues at the bank who finance agriculture about solutions to things like water scarcity? And how does that actually play out, and how does that affect the financing that your bank then puts into the system, which leads to resilient solutions? Because I think Brazil is at the forefront of some of that thinking, and just from CBI's point of view, we're looking to put in a big program around resilient agriculture, but I'm a water person, so I'm quite keen to know how that all plays out. Bit selfish of me, but there you go. Thanks.
Thank you for the question. Actually, Brazil is some steps back. We have 40 million people without access to drinkable water with regularity and quality. So we have huge investment to be done. We have 8 million people without access to sewage treatment. So in our estimate, we need $200 billion to reach universalization of services in sanitation. So, as our colleague said, water is a universal right. So, the first problem we have is to make people to have access to the water. But when you think about agriculture or the economy as a whole, of course, if water impacts agriculture, infrastructure, cities, agribusiness in general, power generation, we have to put financing inside of this. What BNDES is doing, BNDES created as environmental, social, and climate policy, and created some incentivized lines, for example, to incentivize reuse of water, restoration of forest and watersheds, relocation of sensitive assets subjected to floods, flooding, for example, like water treatment plants and sewage treatment plants. And so these incentivized lines try to change the sector as a whole. It's not for one project, it's for the sector. And the more important thing, to access this financing, the companies have to be compliant with this environmental policy of BNDES. So, as in Brazil, the interest rates are high, and we have these incentivized lines, we see things changing inside the companies. So now they're working in this issue, climate change, water-related risks, in order to access BNDES's funding. So, and I think you have some path to follow. I think you have to increase our incentivized products. We have to keep improving the way we analyze projects. Now we don't analyze on the financial issues of the project. You have to analyze the climate and the social risks of the projects. And I think in this way, providing funding, incentivized, and asking for the companies and building solutions together with the companies, we can reach the universalization, and we can provide more stability and for companies, agriculture, infrastructure, and industry.
I think we've got time for one or two more questions. Yes, gentleman here in the tan suit. Gentleman over here.
Thanks very much. My question's for Amy, and I really liked how you set out the 3 stages, but particularly on the second, on where. It'd be great to hear, and again, I want to connect it to a few other things that have been said. In terms of locations of where you may develop a data center or have a data center, could you talk a little bit about, on one hand, you're thinking about current availability of water and how that factors in, but also we heard a little bit about scenario analysis and about the supervisors and central banks is kind of your projections of how much water there would be, and thereby is there some kind of shared lessons about what you at the firm level are kind of factoring in terms of projections for the future to inform your decision today, and thereby the scenario architecture being built on one hand. And then the second is, you talked a little bit about it being very local and contextual. For me, when you said that, there's the parallels from a conservation world of FPIC, so free, prior, informed consent. And I wondered if you could talk a little bit about your engagement strategy. As Elias mentioned in the previous panel, ultimately, water's a finite good. Unlike energy, we're not trying to source or find more. So I guess when you're designing or developing a site, there is engagement with the local community, and whether that goes beyond, say, the planning approval or standard processes to kind of build a site. And is there an engagement strategy with the local community? Because I guess from a CDP point of view, that's something that could be disclosed via your system.
Can you answer those many questions
there's a lot
concisely?
there. So,
briefly, if you can, and then I'd like to get one more in.
Okay. Do you want to take the other one first, or no?
Sure. Yeah. Let's do that. Actually. Yeah. There was a gentleman here. Yes.
So I'm Pete Simpson from the Resilient Water Accelerator. My question's for Andy, actually. You talked about the just transition for water security. Obviously, there's 3 elements to that. About resilience, it's about fair water footprints, it's about the Resilient Water Accelerator. I'm really interested to know whether you think there's a role for any international standards to help make sense of this stuff for central banks, development banks, but also for other investors who are trying to desperately close the gap, for example, on SDG 6. So international standards, is there a role given your experience of those 3 things?
Great question. Amy, do you want to go first?
Sure. So
there's
was that?
No, just briefly, if you.
Okay,
if you can.
briefly.
Yeah, there were a lot of questions.
So we'll talk afterwards. But I guess there's a couple of things that I would say on first of the scenarios of like where we're focusing. I would say, historically, water was not an issue. It wasn't as much of an issue in terms of where it wasn't a factor, both because it's cheap and because it wasn't a constraining issue. I would say now it is an issue in terms of thinking about trade-offs of water and energy and different issues where things are being developed. In terms of scenarios, as I said, we do have, for operational risk, we have zero water design as our new model. So that, in terms of the internal structure, isn't is part of that scenario planning, right? And so it's not as big an issue when you move forward. But the broader issue, of course, is the scenarios when you think about the energy sector, and that we really think about through the lens of the shifting to renewables. It's kind of mixed up in our process of how do we help to decarbonize the grid and expand the grid. And you know, I know I have to be short here, but I do think one way of thinking about the increasing electricity demand from the tech sector and driven by AI is that it is, if we use it right, it's an opportunity for a tremendous amount of investment to go to build the grid in a way that really can facilitate the energy transition and thus the water transition.
Wonderful. And Andy, I think it's final word. I don't want to keep people into the lunch break,
First
so
and last word.
have to be concise.
Very great question, Peter. International standards, yes, absolutely. We've been working on the global goal for adaptation through UNFCCC. I think it's a part of the solution. The water resilience tracker, where that's operating in countries, that gives you assurance the country has not just thought about water risk, but integrated it into national policy. Costa Rica is a great example of that rolling through in Brazil now. Isn't that going to make that country more investable, right? If you've got those two things in place. There's a very human index called the Water Insecurity Index, which is about water insecurity at the domestic level. That perhaps starts to answer the FPIC question. How are people perceiving it? Because if you haven't got the people and the citizens behind it, you can't do anything with tariffs. You can't raise prices because they don't really get it. They don't understand it. And finally, the Alliance for Water Stewardship, which I think is a great but very site-specific standard. We need this turned into a collective action thing. So there's a whole basket of standards there, and I'd love to see ISO pulling that all together. Over to you, Dan.
Joe, could I have 10 seconds just to make a point on agriculture harmful subsidies? More than $800 billion a year are provided to the sector, including payments for producers, general services, consumer support. So if there's a way that leaders, including central bank governors, could work much more closer to see how we could reform the harmful agriculture subsidy sector, which is really externalizing water sector, I think that would be a great win for the multilateral trading system. Second is just very quickly on the virtual water trade. I was hoping to mention that, but I think the WTO and OECD and others could be really well placed to do much more work around virtual water trade with really robust data on where we are on trade statistics, supply chain reporting. And that could be, I think, very interesting with the work of central bankers.
All right. Thank you. You've answered. So we've covered subsidies, standards, trade, pricing, supply chains, development, finance. All of these could have dedicated breakout sessions and even conferences of their own. I'm not going to attempt to summarize and synthesize it all, but we do have a wrap-up session tomorrow afternoon where we'll be teasing out all of the key messages and implications from all of these sessions. So in the interests of lunch, let's wrap it up there. Thank you all for your attention, and thanks to our wonderful panelists.
So many people in this table. Huh? Cuando quieras. Well, hello. Thank you to come back after lunch, and thank you for the previous discussions that made the complexity of water risk very tangible. And I remember, if, again, permit me, I remember a question that has appeared several times during the morning regarding our role as a central bank, even though, or considering that we are not making public policy, and this is out of our mandate. But in any case, I remember a dialogue between President Lagarde and Professor Rockström some months ago in the European Central Bank. And at the end of the conversation, the dialogue, the President Lagarde asked to the Professor Rockström, okay, how do you see the role of central banks talking about nature, environmental degradation, climate, etc.? And the answer was very rich, but one of the most important points is that, first, I think that the central bank has the authority and has the resources to understood perfectly what are the needs, what are the solutions in order to evaluate the impact and assessment on all this kind of risk. And second, you are the most powerful voice to introduce a topic in a country, in a debate, in a conference, whatever you think. And I think that this is the reason why the Banco de España, the European Central Bank, and many other central banks are here, because we really think that we need to understand what is the impact of all this kind of risk, and also use our voice in the following months to explain to the society, to citizens, that this is an important risk, that we need to take care of that. No? And this is the reason also why in this afternoon we are starting with financial authorities here. And I hand over the stage to Marie Gabet, that she will be moderate the session. So, Marie, thank you.
Thanks a lot, Juan Carlos. Can you hear me correctly? Okay, perfect. Do shout if I become inaudible at some point. So just to complete this brief introduction, so I'm really happy to be your moderator for this session. I'm Marie Gabet. I'm a member of the NGFS Secretariat, coordinating the activities of the NGFS Task Force Nature. So you heard our co-chair, Elias, talk a bit about what we do this morning. So alongside my distinguished panelists, we have the difficult task of keeping you awake after the amazing lunch that we had from Banco de España. So we'll do our best. We have a variety of points of view that is going to be really interesting, and we try and stick to the time that we are allotted. But I mean, this kind of meetings is also great because we can have bilateral discussions afterwards. So just to complement on what Juan Carlos was saying this morning, we heard about how water risks are material at the macro financial level. We heard about how they manifest from the real economy, how water shocks then propagate through international supply chains and trade networks, and then ultimately that has material consequences for credit quality, asset prices, financial stability. So during this first afternoon session, we'll focus on the implication of water degradation for financial supervisors. Just as mentioned by Elias this morning, I mean, we are not strictly waking up to the existence of water risks. They've been increasing recently over the recent years, also because as a combination of the increasing climate and nature-related risks. And as also was hinted by Juan Carlos, the work that we're doing at the NGFS based on climate or nature is identifying water, as one of the most material environmental risks for financial actors. So supervisors, they face growing pressure to clarify expectations, to strengthen prudential frameworks, and to embed water into supervisory dialogue. The thing is that, as Mathilde was telling us, this sometimes requires knowledge that usually ministries of environment possess. So supervisors do have to dig deeper on how this risk materialize and how they can draft these expectations. So what we're going to do right now is to study with our panelists how supervisory authorities are beginning to assess water-related impacts on credits, on markets, and operational risks, and how these insights can inform the evolution of supervisory practice across jurisdiction at very different starting points. So we'll also consider how supervisory action interacts with the wider ecosystem of standards, disclosure, data infrastructure that supervision depends on. So we do have a good and dense agenda, and luckily we have just the right panel for that. So I'm joined here by Irene Himskerk, who's the head of the Climate Change Center at the European Central Bank. We also have with us Alberto Casillas-Cuevas, who is a senior advisor to the general director at the Banco de España, but also co-chair of the NGFS workstream on supervision. Then we have Elena Viñas-Listas, who's the chair of the EU Platform on Sustainable Finance, commissioner of the Spanish Financial Market Authority, and also co-chair of the Task Force on Net Zero Policy. We are then joined by Hanne van Voorten, who's the head of supervisory practices and operations at the IAIS, and by Najwa Mouhawi, who's the head of the Climate Finance Regulation Department at the Bank of Morocco. And before the Q&A, we are lucky enough to have Maud Abdelli, who's the lead of WWF's Greening Financial Regulation Initiative, and who will act as a discussant with our speakers before we hand it out to you, the audience. So maybe just to set the scene a bit further on how water shocks, water degradation is relevant for financial supervisors, I'll hand over to Irene, who will give us a brief keynote on water-related risk and on the work of the Climate Change Center on water.
Thank you. I'm going to stand. Is there a clicker here for the... Yes. Because I'm going to share some slides with you. Good afternoon, everyone. It's a real pleasure to be here with you today. And thanks so much for hosting us here and looking forward to discussing. What I really liked in the introduction of Juan Carlos and also you, Marie, emphasizing the relevancy for central banks. And this morning we heard a lot of references to the role of central banks, the signaling effect, that it is macro-critical. Well, I think we all have to agree on that, the macro-criticality, and also the financial risk it causes. I'll share a few slides on how our approach is, just to share a bit, I think, also the context that we're operating as central banks, as maybe not all of you are so familiar with this. So I start with nature, because we're talking about water, but I think we have to start from the big picture first. And on this, you see the conceptual framework that was developed by the NGFS, and one of the key lead people behind this conceptual framework is with us here in the room, and there are many contributors as well. So how do we look at how nature degrades and how does it affect our economy? Just a really basic slide, but I think it's good to have this in mind because it helps us to understand the whole process further. You have nature degradation, so there's a decline in bees. How, in the end, ends this at risk of balance sheet of banks, right? Or water scarcity, how does that affect credit? Strategic risk, credit risk, market risk. We always define the two sources, the physical risk, the transition risk coming from regulation or diverse changes in preferences. This affects companies, micro effects on businesses and households, also regional or sectoral effects, and also macroeconomic effects on outputs and inflation. That's the economic risk. And when banks are invested in those companies or any financial institution, financial actor in the world, this leads to financial risk. And what I think is also important to highlight on this slide, because there are a lot of arrows pointing that way, right, on how nature degradation can up on balance sheet. But also want to put the feedback loops that are in it, right? Because also banks and all financial institutions, everyone in the society also finances activities that might lead to nature degradation. So having that in mind, and also keeping in mind like the two effects, the two ways on how we interact with nature as a society, as an economy, as financial institutions, this is the basis how I see it. At the ECB, we looked into, in 2023, we did a study on the dependency of how dependent is the Euro area economy on nature services like fresh water, fresh air, stable grounds. We found that around 75% of all 4.2 million companies are dependent on at least one ecosystem service. And there were also around that percentage of loans of banks invested in companies that are so highly dependent on nature. Dependency doesn't necessarily say something about risk, because if it's there, if the resources are there, it's not necessarily causing a risk. So what we did further on, we teamed up with the team of Nicola Ranger, with LSE, with Oxford, and we looked deeper into the risk of nature. And here I also have to share that this is quite, pioneering work. When we did this dependency analysis, we could go on firm level. But if you go to risk, we could only look at it from a more sectoral economic output level. So the level of data on risk is not there yet. But I think this research really gives a good already sense of where the risk could emerge. So we did this, and the outcome, when we looked at the euro area economy, the outcome is that water-related risk caused the highest risk on sectoral economic output in the EU. Groundwater, surface water, flood and storm protection. You also see water quality, the filtration. So this is something to keep in mind. And when we saw this was for us a reason to look a bit deeper also into the water-related risk. So we did a study and we assessed a 1 in 100-year drought. Is it feasible? Will this emerge? Well, if we look at the trends, you see that their droughts are becoming more severe and more frequent. But think about 1 in 100-year droughts. It can put 24% of euro area economic output at risk due to surface water scarcity. And if you look at the map of Europe, there's probably something else you notice. Some parts are a bit darker red, some parts are a bit more orange. So you also see that where the risk emerges also differs in regions and sectors. So this is, I think, gives us also a good indication on where we have to look deeper into. So this is the economic output that was put at risk. We also looked into the corresponding share of loans at risk. So 19% of bank loans given to non-financial corporations are invested in companies that are at risk. And we also looked at it's not only the direct effect, but also the supply chain effect. So around half of our overall nature-related risk are related to global supply chain. Here is a slide that we looked a bit more into the sectoral impact. The share of drought-affected areas has increased remarkably in Europe, and agriculture is the most affected in terms of relative sector losses. And that's the one on the left, the bar on the left. And that the left bar with is the dependency. The bit darker color is when there's a 1 in 100-year drought, and then there's if you have a 1 in 25-year drought. So you see, of course, the impact is there, but it's not only agriculture, it's also mining, water supply, manufacturing, construction, accommodation, food services. So to look at it from this perspective, okay, where will the risk emerge, in which sectors, gives us insights again to look deeper into the risks. We also looked a bit deeper into the water-related risk for banks. So the increasing water scarcity and water pollution could become material sources of credit risk, potentially of amplifying systemic vulnerabilities in the euro area. And the highest concentration of loans risk come from water scarcity in the real estate sector. And this is not so weird if you consider that of all the bank loans, 26% is in real estate. So there's a lot of the balance sheets on banks that is in real estate. So that means that the risks are amplified there more than in other sectors. And water quality is more relevant, of course, for manufacturing, mining, and food services. But this, I think, is a bit of an indication on also where the banks see the risk emerging. This is a slide showing good practices of banks. And I really like the remark made this morning by Salome from National Central Bank of Georgia. Like, it's not just telling banks, manage climate and nature-related risk, manage water risk. I think we all have to learn from each other. And that's why we at the ECB published our Good Practices Guide. So in 2020, we already issued our expectations. What do we expect banks to, how they manage climate and nature-related risk? Then a few years later, we also published our good practices, and just recently, I think 2 weeks ago, we published an update of our good practices guide, because we can look into the kitchen of all banks and seeing how they manage it. So we went there and we collected, okay, this is a new innovative way how you can actually manage it. And we collected all those practices in this guide, around 160 plus pages, so take your time to read it, but I think it will give you a good insight of what you can do, and there also how banks to progress on the topic. But let me talk you a little bit to, like, what do we see? Like, we really see that banks are improving on identifying and mapping exposures. So for example, they analyze their portfolio on vulnerabilities across water sectors, and even more advanced banks look also into the geolocation of their assets, postal codes or other areas. On risk drivers, we see that they're really translating droughts and floods into economic variables and linking them to firm-level performance. On the credit risk modeling, they're integrating water risk into credit risk modeling, so they're incorporating water-related risk into credit risk, like probability of default or loan given default. On the running, like the scenarios, of course, what is so important with water-related risk, I think we all see this, that it's becoming much more severe, but we don't know how the future will look like. So running these scenarios and looking forward on how things could emerge and where the risk will sit, we see banks running forward-looking scenarios covering chronic water stress or acute events, so already incorporated in their forward-looking stress testing. And lastly, we also see banks developing metrics and monitoring tools. So for example, indicators to measure exposure to water stress or other things, but there we see, okay, they monitor it, but we do see still room for improvement to tie actions or define metrics. Okay, when is this indicator turning red and we actually need to do something? And what action can we actually put into those consequences? So you see, like, there is a lot of awareness, and we see this really emerging. Banks have made great progress since 2020 when we issued our supervisory expectations. Now all banks have a materiality assessment in place for climate and nature-related risk. Climate risk has been more advanced, but we need to look into the full picture, look into also nature, and water is certainly one of the topics that we see as an emerging risk that deserves higher attention. And I'm really glad to be here today with this panel, and I hope I set the scene a little bit to have to listen and learn from our other panelists, and also get your questions and discuss with you. Thank you so much.
Many thanks for this great stage setting, Irene. I think that now it's quite clear, if it wasn't clear earlier, that we do need to take water into account into our financial supervisory activities. And it's also great to learn about what is being done at the European level on that. So maybe we'll do a bit more of a focus on supervisory practice at country level, and I'll turn to Alberto. And so Banco de España is among the supervisors that are actively integrated water-related risk into supervisory work, right? So from your vantage points, how is water showing up in the credit, in the market, in the operational risk picture? And also, I mean, Irene told us that some banks were quite advanced, for example, when it came to improving their mapping of exposures. But do you see that in Spain? And how do you navigate what might exist as a messier reality, that some banks are ahead of supervisors on this, and sometimes some banks are behind?
Okay. First of all, thank you for inviting me. It's a pleasure to be here and to share our views about these water risks and their impacts. Let me begin with a fundamental message. As Irene mentioned before, water risks is not a new or a standalone category of risks. From a supervisory perspective, it has always been embedded within broader climate and environmental risks, and it's materialized through traditional financial risk channel, namely credit, market, and operational risks. Let me say that they are increasingly a material driven of financial risks. Obviously, their intensity is, let me say, is expected to rise across future scenarios. So, as our challenge as supervisors is to translate that reality into practical supervisory approaches. So, having said that, and from this starting point, water risks manifest differently across the three main financial risk categories. Credit risk is by far the main transmission channel. This is structural. It is where data availability is greatest, where quantitative tools are more developed, and where materiality assessment tend to assign the highest weight to climate and environmental risks. To give you a quantitative illustration, ECB analysis estimate a negative impact of 77 basis points on CET1 under amplified flood scenario transmitted entirely through credit risks. The magnitude of exposure is also significant, not marginal. In Spain, around 20% of bank lending is linked to activities sensitive to water ecosystem degradation, and at a European level, more than 1.3 trillion of euros of corporate credit, over a third of the euro area total, is exposed to sector facing high water stress, often concentrated in regions and industries with intense hydrological pressure. Recent Spanish cases illustrate how these risks translate into credit. The October 2024 Dana event did not lead to a significant deterioration in asset quality, but this was due to public support measures such as eco-financing, moratoria, and the insurance compensation consortium. This showed that hydrological shocks can translate into credit losses rapidly and with a strong geographical concentration, particularly affecting a smaller and more localized institution. And the second example or case in Spain is the drought in Catalonia in early 2024. It's a different type of risk, obviously, but it's chronic, slow-moving, yet disrupted, affecting agriculture, tourism, and urban services. There is also a key structural factor we must emphasize: the insurance gap. In Europe, only about 35 to 45% of natural catastrophe losses are insured, and this gap is widening, particularly for floods and droughts in southern Europe. As frequency and severity increase, insurers are withdrawing from high-risk areas or changing affordable premium. For banks, this has direct prudential implication. Collateral that was historically protected might no longer be insured, and property valuation in high-risk areas may still underestimate exposure. If insurance protection disappears, the residual risk is effectively absorbed by the banks. Regarding market risks incorporate water risks through three main mechanisms. First, supply shocks, for example, when droughts reduce agricultural output or energy generation. Second, valuation effects, including penalties in equity prices and credit spreads for water-intensive sectors. And third, stranded asset risks linked to tightening water regulation or concession regimes. However, the observed impact so far remains limited and cautious, largely due to data constraints. This fact has been confirmed by the ECB 2022 climate stress test. In the third, operational risks is an increasingly important channel, and it comes through multiple vectors. Direct physical damage from floods and extreme events, business disruption and continuity challenges, depends on water resources, for instance, for data center cooling, and importantly, legal and reputational risks. In supervisory practices, quantification remains limited. In the 2022 stress test, operational and reputational risks were assessed qualitatively through questionnaires rather than quantitative tools. At the same time, we observed that institutions are progressively granularizing climate and nature-related events in their operational risks framework. And finally, legal and reputational risks are also gaining traction. Environmental events can trigger litigation, question about due diligence and liability exposure, not only based on what institutions are doing, but also on how they communicate it. And there is also the growing risk of greenwashing claims. Regarding your second question, let me turn to coordination. I would say that the most powerful driver of alignment is not just regulation itself, but the supervisory dialogue and the evidence generated through continuous monitoring, particularly via SREP. And as you know, the SREP in 2022 introduced the climate and environmental risks, and now is fully integrated as 2024. I stop here.
Yeah, thanks a lot, Alberto. So you mentioned, and rightly so, the issue of insurance gap. This makes me want to turn to Hanne next to ask you a bit more about the specific point of view of insurers. So the insurance sector, it sits at a distinctive position on water risk, right? Because of underwriting exposure to floods and droughts and holding investments exposed to the same shocks. So what is the IIS seeing across its membership, and how supervisors are approaching water, and what does the insurance vintage reveal that banking supervision might miss?
Oh, that last one is a tricky one.
I'm sorry.
I'll start with can you hear me okay? Yeah. I'll start with the first part of your question, but maybe first a bit of a disclaimer, because at the IIS, maybe those who don't know the acronym, it's the International Association for Insurance Supervisors. Those of you who are not working in insurance, we often say it's the Basel Committee for Insurers. We're also based in Basel in the same building. And disclaimer is, we don't have a water work stream, so, but that doesn't mean that we don't look at water. So when I was invited for this panel, and I also I looked at all the materials and the work that we are doing, I wanted to take you along the journey of the journey that the IIS has taken on climate risk, on natural catastrophe, on protection gaps, and how water is kind of really flowing through that journey, so to say, in all of our activities. So as we are insurance supervisors, we take a very deliberate, a very structured, and a very risk-based approach. So we started off with one big question, which was, okay, why does, well, you could say water or climate-related risk or extreme weather events, why do they actually matter for us as insurance supervisors? Why is it relevant to our mandate? So that was the first question we asked ourselves. And the answer is not so much, does it matter? And then also, why does it matter? So the answer was a clear yes. And this is one of the things where around the table with the insurance supervisory community, there's really a clear understanding, clear consensus, which, well, there's not always consensus on everything, but there's a clear consensus that this is really at the core of our mandate. So then I'm talking about the prudential mandate around our insurance companies aware of the risks that they are facing, both, as you say, on the investment side, but also on how they underwrite and how they cover the risks, and are they managing it? On the consumer protection side, Are they offering products that actually offer value for consumers? Are they offering products that are available, that are affordable as well? Are they transparent about what they actually don't cover? And then also for maybe the more macro angle, which Alberto already pointed towards, is, and I'll take it a little bit higher abstraction level, is that the question of can insurance actually still perform its role in society and its role in the financial system, its role as risk managers, basically, its role as promoting societal resilience. And there you are seeing, with increasing climate-related risk, with increasing floods, sea level rise, which I don't think it's been mentioned already today, but sea level rise also of course there, drought and other elements, we're seeing increasing risks there. And the big question is, can insurance companies and can the insurance sector as a whole still perform the functions that they are expected to perform? So all in all, this is a first part of our journey was, okay, we agreed this is important for us. It doesn't really matter if you're a conduct supervisor or a prudential supervisor, if you're like in an integrated central bank plus insurance supervisory authority, it matters for you and you have to look at these risks. So then the second step that we did was to look at, okay, but what are then precisely the risks? So dig a little bit deeper. So that means collecting data, doing some analysis, and publishing on that as well. So one example is last year we published, I think it was in November or December, we published a report which was trying to address the question of what are the potential financial stability risks of these increasing weather-related events, under the assumption and under the knowledge that insurance will only become less available. So protection gaps, as we are seeing already, are only going to increase. And we took a bit of an evidence-based case study approach. So we had several case studies. One of them was flooding in Pakistan. Another one was a major drought as well in Malawi. And what you could see there, a couple of lessons as well around, especially on drought, but is that the difficulty to really measure it. So the difficulty to have forward-looking measurements, so that makes it difficult for insurance companies to actually price the risk and to offer the products. You can see also a lack of awareness amongst consumers, amongst those who actually have to think about, should I even buy insurance, yes or no? And also, of course, again, the lack of data as well. So what you see there, this is not just related to these water-related risks, but I think, for instance, for sea level rise, which I do want to mention again as well, is something that inherently is already not insurable. So that is only kind of increasing the additional risks that there are around what type of risk may be covered in the future by insurance. And of course, if it's not covered by insurance, the risk doesn't go away. So it's still somewhere out there. So it's either hitting consumers, small businesses, ultimately then the banking sector, or governments will have to maybe step in with again, various implications. So all in all, I think we all agreed that, yes, there are risks. You need to analyze them. We also saw in that report that the risks are quite different from country to country, because for one, it's flooding, so it's too much water, not enough water. What was the other one? Not clean enough water, right? Yes. So even clean water is important for insurance. I won't really go into that today, but insurance companies also have liability insurance. So then they cover maybe big corporates who, I know there could be something in their factory and then there's water pollution, then actually that's also covered by insurance, but I won't go into that maybe in details. Third point was, so firstly, is it relevant for us? Yes. Do we analyze it? Yes. The third point is, okay, what do we actually do about it? I won't go into detail now because I think we have more details on that later as well. So I'll save that for maybe the second round. What can banks learn? Well, I think we can both learn from each other, to be really honest. If I look at the analysis that you've done, for instance, at the banking side, is in many cases also more sophisticated than what we have done. But for me, the main point that we can learn from each other, I would put it like that, is sharing. So actually speaking to one another, working together. Often what you see is that there has been a climate scenario analysis related to flooding or etc. on the impact on the banking sector. Then I asked the author of that analysis, like, have you looked at insurance coverage? No, it was very difficult to get the data. Or we look at the impact of extreme weather events on inflation or monetary policy. Also there, no, it's very difficult in the modeling to also have assumptions around insurance or the lack of insurance. So maybe us, finding each other more and trying to share data and doing joint analyses, I would say that's maybe something where we can both benefit from each other.
That's an amazing answer, and I said that's a call for actions for central banks and supervisors across the room to see that insurers and banks in general speak to each other a bit more, because I think that's one of the blind spots that we sometimes have in general. So that's great that you underline it. Thank you, Hanne. So maybe, hopefully, if we do that, we'll manage to set really clear expectations from supervisors. But Helena, I'm now turning to you. Supervisors can clarify expectations, but those expectations, they only translate into practice when the wider regulatory architecture, so taxonomies, disclosures, data assurance, is moving in the same direction, right? So from your vantage points, chairing the EU platform, where is that architecture now? Is it ready to support supervisory action on water?
Thank you so much, Marie, and good afternoon to everyone. It's a real pleasure to be with all of you today. But actually, what Marie has just asked me, it's slightly challenging, because in a way, you've asked me to not only try to explain you in less than 5 minutes, but it's the architecture of, the regulatory architecture of sustainable finance, but also to provide a sort of a first assessment and all of that through the lenses of water. So please bear with me. It's not simple. And last but not least, on top of it, after lunch. So I'll try to do my best. The Sustainable Finance Framework, the regulatory framework, is basically, by and large, a transparency disclosure framework. So that means that supervisors were not going to judge or assess the actual reporting. You're just looking at whether or not companies and the different financial market participants disclose what they are supposed to disclose, and in the way that the regulation says. So that is really important, because we've seen in the market some real misunderstandings sometimes, for example, when it comes to financial products, where they took, what it is, and apologies for all the terminology, Article 8 and Article 9 funds, so two categories, as categories, when actually they only say, if you register it as Article 8, then you need to disclose that. If you register as Article 8, you need to disclose that. And people thought that that might have been a guarantee of actually the performance of the impact of those funds, which is not. And that needs to be really highlighted. So that said, basically has two foundations. Yes, on one hand, the European Sustainability Reporting Standards, the ESRS, and on the other hand, the taxonomy. The ESRS work at entity level, and it asks companies to disclose a series of indicators, if they are material, because the vast majority, particularly now with the revision that has just taken place, not totally finalized, but almost, basically most of the indicators, particularly in water, are only to be disclosed if the company believes that it is material from a double materiality perspective. On the other hand, the taxonomy operates at activity level. The taxonomy does, though, and is the only tool that actually sets up performance levels, and it tells you, which performance levels you need to achieve in order to be considered sustainable. And this is really important, because both tools are very complementary. And these are the main tools that then financial market participants and financial institutions have to then sort of construct their green loans or green bonds, or let's talk about blue loans and blue products, or the financial products on one hand, using ideally the taxonomy, because then they could aspire to get the EU Green Bond standard, because the regulation actually sets that golden standard, which is the EU Green Bond standard. So you get, your stamp. You know, on the other hand, again, financial market participants and financial institutions can use the disclosures from the ESRS and the bit of the taxonomy I haven't talked yet, but the taxonomy has, most of you would know, what we call substantial contribution. This is how you actually contribute to achieve the water objectives, but also the do no significant harm criteria. So making sure that no matter in what you invest, you are not going to harm the water, you know, you're not going to make things worse, basically speaking. So you can use that to de-risk your portfolios, whether we're talking about credit portfolios or investment portfolios. So really, really summarize in a nutshell, that's what the regulation out there is. So what's the state of play? That's the question. Well, when it comes to the ESRS, I'm sure, or the state of entity level data reporting, CDP is much better placed than I. But as you may know, not all countries have transposed the directive. It has been revised, so we're going to leave that to aside. I am just going to make two comments. I really wonder, and this is a real question mark, with this new approach, top-down to double materiality, where the company decides whether or not it's material, how many companies are actually going to disclose water, you know, related indicators, taking into account already that the scope of application in terms of those companies that need to report has already shrinked in an 85 to 93%, and that the water indicators in a 70%. Maybe we improve the quality because as there are few indicators now and few companies, maybe all of them report, that's yet to be seen. But the other thing I wanted to comment is that what it is clear is the taxonomy becomes more important because all the companies under CSRD need to disclose the taxonomy. And I ask yourselves, you know, ask you, if a company conducts an activity that is included in the taxonomy, doesn't that mean that it's material for the company? I would say, you know, it would be very difficult for companies that have activities included in the taxonomy to say they're not material, water is not material for them, and therefore I ignore the water E3, which is the water list of disclosure. In terms of the actual performance on the taxonomy, we just hit the 1 billion. So the taxonomy between 2021 and 2025, these 1,900 companies that report on the taxonomy have invested more than 1 billion euros in align with the taxonomy, that is in align with the climate objectives. But 80% of that, it's on climate mitigation. And one of the things that we realize is not only, and we need to be very clear, is not only that climate has captured most attention, but also we need to be fair because the reality is that the taxonomy is incredibly biased towards climate mitigation because it has 110 plus activities in climate and only 15 in water. Yeah. Also, we realize that a lot of companies do not disclose for all the environmental objectives that we might have, and this is something that we're looking into. You know, problems on reporting against other environmental objectives other than mitigation. But that said, the good news, and this for me are really good news, is understanding that 1 billion has included the do no significant harm criteria for water. So it means that we might not be investing much on water-related, new solutions or activities, but at least we're not harming, and what is invested in line is not harming. That's one. The other thing I wanted to very quickly share with you is that when it comes to bonds, I think we are on the 5 billion of blue bonds, which is relatively decent if we take into account that, again, we have real problems of capturing the real investments in water. Like with funds, we have the same problem, which is the majority of bonds and the majority of financial products are not labeled exclusively as blue, but they are green, and within that, they have a part on water. And that, we still haven't really properly monitored what is that part of investments. Having said that, when you look at the green bonds globally, 75% is on mitigation in 3 sectors, so real estate, energy, and transport. So you start getting a little bit of the picture. When it comes to, and I finish with this, with portfolios, funds, we're talking about 39 billion, I think, globally. But the good news is that half of that is Europeans, so it's Europe made, but it's roughly 2% of all the funds. So we're still really struggling, basically, to cut a long story short, to make specific investments in water that tend to come more with the rest of the environmental objectives.
That's very interesting, and I hope that it's food for everybody in this room. It's great to hear about exactly how investments are at the moment. So great picture of that. Thank you, Helena. So maybe to end this first round about our state of play in terms of financial supervision of water, I'll do a bit, go away from the European focus, and I'll ask Najwa to tell us a bit about what's happening in Morocco. So Morocco is dealing with real and intensifying water stress, and its central bank is developing a supervisory response in that context. So could you tell us a bit about what it looks like to build supervisory capacity on water in a jurisdiction where the risk is already materializing, right? And what should supervisors in more water-abundant markets learn from your experience?
Thank you, Marie. I would like first to thank the Bank of Spain for the great hospitality and the OECD, NGFS, and CDP for organizing alongside the Bank of Spain this session. And thanks for having me and for having the Central Bank of Morocco. Morocco has been mentioned a few times earlier, and one can guess how much of water stress we are actually experiencing. Morocco is one of the most water-stressed countries in the MENA region, and according to the studies of the World Bank, we have 33% of our GDP which is at risk from 2 or more natural hazards. This is due to our geographical position and high rainfall variability, so we are really very prone to climate and nature hazards. Forward-looking studies as part of the Climate and Development Report I have mentioned also this morning show that Morocco may experience climate-related water scarcity before the end of the current decade, despite some commendable government policies. So at the level of, so critically African countries, and why I'm talking about African countries, because that was perfectly mentioned this morning, the cross-border exposures do matter. Critically, African countries could lose up more of their GDP because of nature-related risks, and the economic impact would affect negatively and heavily the financial sector, more than in advanced countries, because we do have weaker structures of financial markets that have insufficiently deep financial markets, insurance markets that are still developing, and the credits are most of the time concentrated in banking portfolios, which exacerbate the impact on the financial sector. In Morocco, for example, the agricultural sector has a high economic relevance, and the financial losses from nature-related risks or climate-related risks could directly spill over to key economic activities that Moroccan banks are financing, especially due to output-input linkages. So as a central bank and banking supervisor, and as part of our risk-based supervision, we do assess risks to banks' activities. While in the past the financial losses weren't identified as being maybe climate or nature related, the simple mapping between the non-performing loans in the agricultural sector and the past dry events reveals how much our banking portfolios are actually vulnerable to nature-related risks. With this in mind, we have actually started addressing nature and environment-related risks back in 2016. By first convening and financial sector platform. Coordination and strategy were key starting points, especially in an emerging market context. It's essential to provide the signal to the market, to the wider society, to have the buy-in, to implement also the institutional coordination, the public-private coordination process. Building capacities were actually the next step, and as it was also mentioned by our colleague from Georgia, it's important to build the capacities and the skills maybe before defining the supervisory expectations. So in 2021, we have defined our supervisory expectations to banks on how they should be managing both climate and environmental-related risks, through risk management, strategy and governance, scenario analysis, and disclosures. And as we moved over time into more technical guidance, it was actually easier for us to address climate-related risks. So we've had a climate-first approach, very gradualistic, but our global regulatory framework is flexible enough and could accommodate additional supervisory expectations for nature. So the NGFS guide for supervisor was a useful source of guidance for us in defining our expectations. We have then run our risk assessment to assess the extent to which Moroccan banks are exposed to drought and flood events, but also to transition risks. And the estimates are an unsurprising reminder of the vulnerability of banking portfolios in Morocco to physical risks. So after we've performed this risk assessment, now we're trying to move into a full supervisory process for environment-related risks, and by promoting more revealing disclosures, because data was the mostly common actually challenge. And when we've performed also run our stress testing, we figured out how difficult it could be to access and translate maybe climate data into finance-related impacts or economic impacts. So we're trying to promote more revealing disclosures. Today we are requiring from bank ISSB 2 standard is implemented and in place in Morocco, and starting from next year we should have ISSB disclosures from Moroccan banks. It's a mandatory requirement. We've been quite more ambitious than the Basel Committee because it was published before. It released its principles, and we're also trying to build the risk data aggregation capabilities of banks. We have introduced prudential reporting for banks on large borrower exposures to climate-related risks. This would help to make sure that the internal reporting practices of banks could produce timely information and monitor material environmental-related risks and include some of the mostly relevant nature-related risks. So today we are also, as we move forward, we are trying to build our supervisory capacity and try to avoid disconnected approaches and have an integrated supervisory process for both climate and nature-related risks. And we're trying to utilize the international expertise and the tools that are being actually developed by the NGFS. And we do think that the methodologies and tools that are already in place are hopefully helpful to help us also cover and extend our supervisory process to cover nature-related risks. We have already covered drought and flood events as part of the climate vulnerabilities, but it is also within the nature broader scope. But we are striving to also cover all the nature-related risks, especially as we have a greater exposure, and we cannot wait to take any immediate actions. So we do believe that the current practices, methodologies, and tools that are in place would help us in this way. And we do need also to assess the extent to which the Moroccan banks are exposed to wider nature-related risks. It's important to determine the historical nature events' impact on GDP. That would help to better calibrate maybe also forward-looking scenarios building on the work the NGFS is engaging on. And the greater the exposures will be, the more serious and severe the responses, prudential responses will be from the central bank and from Morocco. We may also consider introducing some technical reporting guidelines on nature-related risks, especially as the Moroccan taxonomy is currently being developed. It should be completed by next year, the end of this year. So we could seize the opportunity of this taxonomy to have more prudential focused instruments and more revealing disclosures covering also nature-related risks. That would be the necessary prerequisite for our nature-related risks assessment exercises. But when we think that the compliance with our regulation, recently issued regulatory guidances on both disclosures, prudential reporting, and the wider risk management framework for both environmental and climate-related risks would help to improve the capabilities of banks that are actively implementing and have either implemented or are actively implementing data infrastructures and improving their analytical tools. So it would be easier for them maybe to account for nature-related risks. For the sake of time and to conclude, I would say that in a fast-moving space, quite a number of resources and materials are released every day, and we are trying to keep up the pace while being mindful of the limited expertise and capabilities of Moroccan banks that are now working actively on climate-related risks. I'll stop here, thank you.
Thanks a lot, Naja. It's great to really hear about the detailed process that took you through supervision of climate risk to nature risk now. And well, I'm personally very happy that you mentioned nature and that you're trying to do as much as you can to identify nature risks. And I think it's really important to stress how capacity building is key to build knowledge on this and to act on these kind of risks. So it's great that we mention it quite often in this roundtable meeting. It's also, I guess, one of the main missions of the NGFS, so I really resonate with what you said. And that allows me to do a bit of a commercial break between the two sessions of this, the two rounds of this panel session, and mention the fact that the NGFS recently released a note on the supervision of nature-related risks. That could be also interesting for capacity building purposes, and that has a lot also to do with what was shared here. So maybe, for the sake of time, we can do a condensed version of our second round that would be on lessons learned and next steps. So I might ask all of you to give me the abstract of what your answer would have been. So maybe I'll turn to Irene first. Based on what was said during the first round of this panel and from the ECB's perspective, and the work of the Climate Change Center, where does the supervisory frontier on water need to move next? And what is the ECB's ask of peers around this table to get there?
Thanks a lot. Well, first of all, we need to stay the course, and we need to go into the weeds, because we can talk about and we can easily agree on water-related risk or nature-related risk or climate-related risk is important, but how do we actually see it? Well, I showed on the slide that banks are making progress. What we have in the books, I'll mention two things. One is we'll do deep dives on physical risk. Climate, nature, and water is obvious one of them in the coming, starting soon and in the coming years to go. Learning there more on how banks actually manage risk, look into the kitchen and see the practices again and see how they can move forward. Second part I would like to highlight, we had a very good meeting, our first meeting of this group in person yesterday here, within the so-called Euro system of central banks. So that means all central banks in the EU. We got a group together on water risk. And it was so motivating to discuss the different lessons that we can learn from each other and being in the room with the colleagues. And many are in the room here today as well, from Malta, Cyprus, Germany, Netherlands, France, Spain. And I can mention more, in total 12 national central banks and the ECB working together, co-chairing this together with Banque de France, with Stefan Dees. What are the macroeconomic impacts? What are the financial stability risks? And what is the data that we need for that? So that's something that we'll be working on. At some point comes to the phase of maturity and then we'll publish it. And I hope that is useful for everyone. And that brings me to your last point on, what can we do with peers? What are asked? And I think it was already mentioned by Johanna, like make sure that we share all this kind of information and we make sure that we progress together. I always say it a bit like we need to talk to strangers because you often talk to your neighbors or the people or the central bankers around you because you speak the same language, but really talking to people who work with water on the field, learn from them, where are the risks emerging, learning from how the banks see the risk coming, and also trying to really, in the end, preserve the water that we have. So 2 things in the books.
That's great, thank you. Maybe I'll change a bit the focus and turn to Helena for a quick question, an abstract of an abstract. So if the surrounding architecture has gaps, whose job is it to close them? What can the EU platform and similar bodies actually deliver, let's say in the next 2 years, that would ensure that risks are properly integrated by financial actors in order for supervisors to be better supported?
Yeah, thank you. But let me start by rectifying something I said before. I was talking about 1 billion, that we reach the 1 billion, the taxonomy, and you probably were thinking, why is she making such a fuss for 1 billion? I actually meant 1 trillion. We reached 1 trillion. So very important, yeah? We reached that historical level of 1 trillion. So now you see why it's such an event, yeah? So, talking about that, the first thing we need is to improve the reporting, the corporate reporting, when it comes to other environmental objectives other than mitigation. So that includes, obviously, water, number one. Number two, we need to, and this is part of the monitoring of capital flows towards sustainable investment that we are conducting, the platform, we need to start being able to extract and start estimating how much of those investments I was talking about, those green funds, those ESG funds, green bonds, actually is going really into water, yeah, and water solutions. So that's the second one, and we're starting to work on that. The third one is that you probably realize that when it comes to the taxonomy, I talk about 110 activities versus 15. So maybe we need to boost a little bit more the water taxonomy and expand it. And one thing that is very interesting is that in the taxonomy for mitigation, for example, for renovation, you actually allow to count for individual measures. And you would say, what is that, Elena? Well, imagine is that I'm a company, of a marketing company, and I decide to change all my windows for triple glazing. So that investment counts as green capex for me, but also the company that installs the new windows also can count the revenues. But that allowance that it is for mitigation is not for the rest of environmental objectives. And that makes up of a lot of the investments that companies that might not have their activities included in the taxonomy can count on. So that's a priority, but then more broadly, expanded. And linked to that, to say that sort of, misregard we have for all the environmental objectives that they are not mitigation, it's also in the regulation, we see it in other tools. For example, we have climate transition benchmark, the Paris Aligned benchmark, but we don't have water transition benchmarks, right? So what does the transition mean for water? What does it mean, a transition plan, if we integrate water, and what does that benchmark? It exists because we do have ETFs in the market, so funds that replicate, passive funds that replicate benchmarks, but they are privately made. There's no sort of reference point. So we would like to work on that. And if you allow me, one last thing. And this is almost like a plead. Maybe it's like throwing a bottle, with a message into the ocean, yeah? But I believe that you're absolutely right, is the European Central Bank, the OECD, NGFS, and many others, when you say, well, the climate scenario analysis needs to be much broader. Absolutely agree. It needs to include water and nature ecosystems, yeah? Because climate scenario analysis doesn't fully reflect water risk. But the problem, the situation we have now in Europe is that, Brussels has decided to, even for climate scenario analysis, to only have to be disclosed if used. Basically, for the first time, putting Europe below the international standard, international bar. And we all know the international standards are the minimum common denominator. So one plea, and I will finish with this, to all of you, is that we still have that tiny, tiny, narrow window of influencing and changing that. Please raise your voice, because we do need climate scenario analysis. Thank you.
Couldn't agree more. Thank you for the call to action. So maybe since we heard from you exactly who can help close the gaps, maybe I'll turn to Najwa. Very briefly, in let's say 2-3 sentences, could you maybe tell me about what is most needed for emerging market supervisors that are building capacity on water from the international community? Is it technical assistance, peer exchange, data?
Yes. It's difficult to have it on three sentences, but I will give it a try. Actually, supervisors in emerging markets and developing economies are facing a double trouble, I would say, because on the one hand, we have the greater exposure, so we cannot wait. We need to have some early on actions on which nature-related risks, identification, assessment, and management. On the other, we do not have sufficient capacities. So we do rely on international community a lot, and it's thanks to the international support, especially the World Bank, EBRD, and other international partners, but also through our membership in the NGFS and all the resources that were provided and from which we have hugely benefited. We've been able to step forward in the climate-related risks management area, and so we are seeking more practical guidance on the data development methodologies for assessing and measuring the risks, because this is where the key challenges lie, both for the central banks and supervisors and financial institutions. So we do rely on the international practical guidance. Events like the one we are attending today are really valuable and helpful for regulators in emerging markets and developing economies on this direction, the policy direction they need to take. But also we need to also converge toward a minimally accepted principle-based framework, set of scenarios, set of requirements and rules. It's important to have an action from the standard setting bodies. This helps also promote the consensus at the global level. It promotes cross-jurisdictional cooperation, and while paving the way for regulators and supervisors in emerging markets and developing economies to add on some of the granularity and country-specific rules. I'll stop here.
That's amazing. Thank you for being sharp on this. So given the little time that we have left, and for the sake of not overshooting too much, let's say that I'm just going to ask a broad question to both Alberto and Hannah. Two things that I think we should broach to just close and conclude this panel is, one, the supervisory expectations on water that would be most impactful for financial institutions, and also, you raised that point, Najwa, and it was raised before, where international convergence and supervisory expectations around water need to go in the near term. So both of you, maybe first Alberto, then Hannah, could you tell me on either what would one or two supervisory expectations on water would be most impactful, and how we can converge internationally?
Okay, thank you. Let me start with a clear and pragmatic message, supervisory message. Regulatory framework for water risks is already in place. So our challenge is not longer its design, but its effective operationalization. So this is the clear message that we need to share with our audience. Looking ahead, we will see two important developments in the very near term. First, the mandatory inclusion of water risk scenario within ICAP and stress testing frameworks from 2027. And second, comparable disclosure requirements under Pillar 3 by December 2026, which will significantly enhance transparency on exposure to water risks. But however, what will truly drive change over the next 12 or 18 months is not new regulation. It will be how institutions incorporate water risks into their actual decision-making processes. So from a supervisory perspective, this translates into two key expectations. First, integrate water risks into central management mechanism. So water risk should not be treated as a site analysis. It must become embedded in core management framework, and this is operationalized through three key levers. First, risk appetite framework. Second, collateral valuation. And third, water risk scenarios and ICAP. These three elements are interconnected, and better integration in risk appetite combined with improved collateral institution evaluation obviously implies a stronger credit risk models and a more robust ICAP framework. And the second expectation is integrate water risks into strategic planning. It's about credibility in long-term planning, this will be assessed through two major supervisory chain exercises: horizontal supervisory analysis in 2026, focusing especially on physical risks, including water, and secondly, the ECB thematic review in 2027 on transition plans, which will evaluate whether water risk is genuinely embedded in banks' strategic decision making. And regarding your second question, it's just 1 minute. How to achieve a cohesion across institution and jurisdiction, avoiding a fragmented or mosaic approach. Well, it's important to recognize some degree of diversity. It's natural and even necessary. Difference in exposure, data availability, and institutional capacity justify differentiated approaches. However, cohesion can be achieved through 4 structural pillars. First, common expectation combined with proportional implementation. Second, the SREP as a true alignment mechanism. Third, the development of a shared data infrastructure. And 4, institutional coordination and supervisory networks. So let me conclude with just 3 messages. We do not face a lack of regulation, but a gap in consistent implementation of this kind of risk. The most expectation are those that embed water risks into core decision, risk appetite, collateral evaluation, and so on. And true cohesion will not come from uniformity, but from a combination of common standard, proportionality, a strong SREP process, and a shared data information.
Amazing. Well, it's great to know that we have concrete steps to look forward to and that you have very concrete propositions. So maybe, Hannah, you can be our nice conclusion and tell us a bit more about international convergence.
Yes. Yeah, I'll try to bridge between international convergence, mention of supervisory practices, supervisory action, but also bridge it to the reality of today, which is that a lot of supervisors, central banks, are also constrained in resources. It's not just the capacity, but also the resources. You can only have so many top priorities every year. So what we are also seeing amongst our membership is that even if maybe water or climate or nature is not the top priority in their supervisory plan this year or in their etc., actually they are already taking a lot of measures that indirectly actually also help benefit solving the issues around insurance protection gaps or issues around insurance availability and managing fiscal risk. So I'll name 2 examples, if I may, and then I'll close. So one is risk-based supervision. You mentioned it already. So a lot of our members, especially those in emerging markets, are moving towards risk-based supervision with, I think people know what that means. So risk-based pricing, risk-based capital requirements, looking at the boards and the governance within the companies to really have a risk-based focus. Ultimately, if nature, if climate-related risks, if water-related risks are going to be indeed material or relevant for that group, it will have to be managed. And secondly, there's a lot of emphasis, again, in many different countries, but especially developing economies, on the supervisor creating what we call an enabling environment for innovation. So then it's about microinsurance, it's about parametric insurance, it's about maybe sometimes public-private partnerships, and also they're maybe originally not necessarily targeted towards water, but it was targeted towards maybe SMEs working in agriculture. Well, automatically, if you increase insurance coverage, if you work on parametric insurance and other things, then you will automatically also help coverage for either drought or flooding or other water-related risks. So I think my main message is, in the end, we all, whatever we do, even if we're not focusing on water, we are actually already doing a lot there as well in that area.
That's an amazing message to take away. Thank you, Hannah. Okay, so without further ado, I might hand it over to Maud for a few questions.
Thank you very much. It was a really interesting discussion. Thank you for having us today as well. A lot has been said, a lot of very important things. So first, obviously, water is a systemic financial risk that is closely interlinked with climate change and nature loss, making it a real system issue that we are all responsible to solve at the end. And at the same time, we are seeing a very uneven landscape across financial institutions wanting to integrate a water-related risk, with often the larger ones already quite advanced in the integration of this risk, while others are still a bit lagging, which raised also some challenges for supervisor, I guess. Second, the supervisors are clearly moving, but within constraints set by the broader regulatory architecture, but also set by specificities of nature and water-related risk. And we often risk that even if materiality is increasingly recognized, we often hear that progress still depends on research, data that are lacking, or other enabling frameworks, tools such as disclosure or taxonomy, for example. And third, what we are at an inflection point in supervisory expectation and action. But this shift will require supervisory action that are backed by forward-looking information on the risk, the impact, but also the opportunity to integrate water into financial decision-making. So I'd like to just ask you very briefly, so that a lot of financial institutions are operating globally and internationally. So it raises a certain issue when supervising them. And the first question is in the enforcement of your supervisory expectation, how you are making sure that the expectation you are issuing for banks and for insurance are being implemented. And can you also give us illustrative example of concrete action that can be done if it's not the case? The second question relates more to the tool. We are more and more talking about transition plans, and the discussion is evolving on transition plans. So, but for you, what will be the minimum thing you would like to see on, in transition plans to cover water-related risk? And the third one, which is an important one, is if we want to solve this big systemic issue, we need a bit more collaboration. How this collaboration could materialize across geographies, but also across different financial sectors, such as banks and insurance, but also asset management. Yeah, I leave you the liberty to answer if you are inspired.
If I may, maybe to share some concrete examples on the international perspective. In Morocco, Moroccan banks are actually also exposed to African markets. So whenever we are setting supervisory rules, they apply to both domestic and international cross-border operations. We do have some sort of collaboration which is already in place with African counterparts and supervisors. We do held each year what we call a college of supervisors, where we are gathering all the supervisors of the African region where Moroccan banks are having their subsidies, and where we also address, among other key matters, climate-related risks, regulations, supervisory expectations, what needs to be done. And it's a platform of discussion where we are also informing the supervisors, on the other hand, on our rules that will be applied to their supervised entities, and in some cases, the other supervisors have already a similar expectation. So this is how we are trying to make sure that we have an alignment at the global portfolio that Moroccan banks are financing by leveraging the collaboration and cooperation process, which is already in place on supervision. So in a very near future, once we will start this risk-based approach, which is actually considered starting next year, where we may require additional capital for banks that are having excessive exposures and not implementing the necessary frameworks or processes and tools in place and not allocating sufficient capital, we would seize also these supervisors to make them informed about that, and they would do the same for the subsidies. So this will be starting very soon. Now we are conducting pilot exercises and on an informative manner for both supervised entities and the African supervisors. So this is how we are dealing with this international exposure to climate-related risks. On the other hand, maybe for the transition risks, we are having a close collaboration with our European counterparts, especially as the carbon adjustment border mechanism is in place, and it's affecting some of the exporting activities in Morocco that Moroccan banks are actually financing. So we've had the opportunity to prepare banks to this, and We have also conducted a qualitative assessment to see to what extent they would be exposed, and the good news is that they were quite prepared for that, and that the larger operators that are exposed to these mechanisms have already the necessary technical and financial capabilities. So those are two concrete examples about the international supervisory perspective, I would say. Your second question was on collaboration. No, not on collaboration. It was on collaboration. How we could collaborate internally and at the international level. I'm not going to repeat what I have said earlier, but we've seen the value of partnerships and being active in international fora for our agenda, and the international collaboration was was a key driver of our successes so far. At the national level, we have touched upon the financial sector platform. We had a roadmap back in 2016, and we've also set up a strategy for developing green finance by 2030, and this was done alongside the Ministry of Finance, the financial regulators of capital markets, and insurance companies, because in Morocco the central bank is only supervising the banking sector, where we should keep in mind that the banking sector is the major part of the Moroccan financial sector, but still we are trying to have an alignment on the disclosures, on the regulations, on the supervisory expectations, to make sure that the whole segments are actually having the same expectations and level of ambitions. We're also trying to seize the opportunity of this strategy, because it's also considering some concrete actions from the corporate side, because in Morocco we have some sort of distortion between the corporates and the financial sector, which is quite active in managing, disclosing, but the major part of data is depending on the corporates, and they should have the same level of engagement. So we're now working through this financial sector strategy to get everyone involved in the discussion and take the concrete actions, because we are considering concrete actions with a defined deadline for each of the key stakeholders at the national level, to make sure that we are mobilizing the full capacity of financial sector towards climate action and environmental sustainability.
Thank you for those examples.
Does another one of the panelists wish to answer mode in literally 1 minute, because I want to keep good working relationship with Noelia, who moderates the next panel.
Okay.
I can add another concrete example of, you mentioned international cooperation, maybe cooperation between insurance and banking. Yesterday and the day before, the Basel Committee met in Basel, and they always issue press releases just after that. So this is all public knowledge, but they are going to work on extreme weather events. So that's the Basel Committee on Banking Supervisors. And they will explicitly also look at the role of insurance, the extent to which banks have insurance coverage in place. And there we as the IS and the Basel Committee are working together also to see how we can actually close this. I don't know what gap it is, but in any case, work together, talk to one another, share information as well, because we have done similar work. And so this is maybe one of the first times that actually the Basel Committee and the IS are going to do some coordination on that type of topic. So that's maybe another example of cross-sectoral coordination across financial supervisors.
Thank you.
Right. Well, then maybe a warm round of applause for our panelists. Thank you. And we'll let the other panel take the stage.
Hello? Hello? Please? Please? Hello? Hello? You can, please. Okay, thank you very much. Meanwhile, our next session starts. I would like to share with you a couple of things. No? First, maybe most of you, we wanted to arise some questions, but tomorrow in the 7th session, we have the opportunity to maintain a dialogue with all of you, probably. So don't worry about that. My second comment related to the previous session is that even though Maud has made an excellent summary and discussion, I remember my old times in the Spanish Banking Association before the Banco de España, and I remember the first days on climate change. And I think that the most relevant tipping point when we are talking climate change and financial institution was supervisory expectations and stress testing climate. So these two tools related to supervision are crucial, was crucial in that time to introduce these topics in the financial system. Now, I think that we have the opportunity to do the same in nature and water-related risk. And my second comment is related to the following session, because NGFS have just published a very, very interesting paper on catastrophes worldwide, studying 31 cases around the world in the last few years, and they have estimated that the cost of these catastrophes has been close to $200 billion in the last few years. Most of them, more than 70% of the catastrophes were related to water-related risk. So the question is, who is paying these catastrophes? Who is paying this fiscal debt? Who is paying the problems related to this risk? So I think that this session is precisely ideal to answer this kind of question. But before that, let me introduce, apart from the content, I am very happy because Esther Gordo, one of the speakers, was the first person that I worked with here in the Bank of Spain many, many years ago. And I'm happy to introduce once again with Esther. And Noelia, the moderator, that will be the moderator of the session, is part of my team. And this session, this conference has been successful so far because of her. So thank you very much.
Okay, well, good evening or good afternoon, everybody. Welcome to this session 4 that I will be moderating today. And before we start, let me remind you that the session is being recorded and that pictures might be taken as well. And to start a little bit about the logistics, we're going to have a couple of rounds of questions with the speakers that we have here today, and then we will open the floor for questions from the audience and online. So let me start by setting the scene for the discussion over the next 1 hour and 50 minutes or so. We all know that water risks are being increasingly considered as a micro-financial stability challenge, but it's not so much considered as a core fiscal risk. It's more like a background risk. However, it's clear that droughts, floods, or any kind of problems with quality of water have direct impacts on the fiscal balances in revenues and also in expenditure. Think about any kind of expense of reconstruction, any kind of support for families or firms affected by this kind of extreme events, and also revenue losses, of course, if the production stops in the area affected. This, of course, can even translate to the debt dynamics of the public sector, and affect also the way financial markets see the credit risk of the sovereign debt and sub-sovereign debt. The transmission channels of water risk to public finances are very important for governments, not only because they affect fiscal balances, but also because governments face a difficult choice in between investing in resilience to be more resilient to face these shocks, or complying with normally tight fiscal rules and constraints that they may have. So to talk about water risk, we have an outstanding panel of experts here on the stage that I'm very, very happy to welcome you all. We have Roundtable, who is Vice President and Senior Credit Officer in Moody's Sustainable Finance Group. Esther Gordo, who is right by my side. She was a colleague of mine 2 years ago. She's Director of Economic Analysis at Spain's Independent Fiscal Authority. Hélène Gerhardt, Senior Economist at the Agence Française de Développement. And we have also John Matthews, who is Director of the Alliance for Global Water Adaptation. And finally, we have Tim Segbor, Senior Advisor for Regulatory and Corporate Affairs at the Public Sector Bank, NWB. So welcome. Thank you for your sharing, for you sharing all your thoughts and insights that I'm sure that you are going to handle us. And well, let me just kick off the discussion. I would like to focus first on the credit perspective of the water risks. And it's true that water is increasingly recognized as a transmission channel of the effects of climate change, with very strong impact in economic output and fiscal balances. So Ram, from Moody's ratings perspective, I would like to know if you can provide some thoughts on where is the water stress already showing up as a material credit consideration for sovereign and sub-sovereigns, and what determines whether similar levels of water stress produce different credit outcomes. So I think that you have prepared a couple of slides. So the floor is yours. Thank you.
Sure. Well, thank you so much for the introduction, Naoli. And it's great to be here, hearing so much rich content throughout the day, and a pleasure to share how Moody's looks at these risks, especially water management risk. So just to start off with, I have 2 slides. We'll try to get them over relatively quickly. It's been a long day to everyone, and you've heard a lot of content, so I want to keep my comments very punchy, very, very short. So water management or water risk for Moody's is not a new risk that we've looked at. We have water management within our methodology. It's one of 5 environmental pillars, along with natural capital, carbon transition, waste and pollution, and physical climate risk. So it has its own pillar within our sustainable finance methodology. But the interesting story is really the scale of how water management has risen. So back in 2020, the exposed debt of water management risk was about 900 billion across all our sectors. And the number today, that's 2 trillion. And so that's doubled in about 5-6 years. And this analysis, our global analysts go away every year, look at all the sectors and rate each of the 5 environmental risk pillars. And again, water management is coming up the ladder. So as you can see here, at the top, you have the critical minerals, you have oil and gas, water and waste pollution. But also on the bottom, you can see where we have regional and local governments, coal mining, and infrastructure projects. So when we look at the issuer level, we actually have 1/3 of our rated debt sovereigns who are exposed to already water management risk. So this means water management risk is already impacting their credit metrics, the fiscal space, and so on and so forth. So I think that's a pretty big number there. But also another big number, we have 6.5 trillion worth of debt, which have moderate risk to water management risk. And what you can see here is sectors such as data centers, semiconductors, all are right now have moderate risk to water management risk. But with credit, our focus is very niche. Exposure is not always risk. So what I want to show you, again, at a very high level, is how Moody's looks at these risks. Essentially, water is a mechanism for physical climate risk impacting economic balances and fiscal spaces. So as you can see here, we look at three, this is a very high level, obviously it's very nuanced with different sectors, but at a very high level, we look at scarcity. So we can see examples where we have the Taiwan drought impacting semiconductor industry, Zambia hydropower failing, impacting 12 hours of no electricity, and so on and so forth. And of course, the Panama Canal impacting almost 20% of flows through supply chains. So this is scarcity. And of course, we have flooding, which is a lot more acute. Of course, we've spoken about Dana flooding with Spain, which impacted a lot of lives, but also billions of dollars or euros of impact. But also, in 2022, the Pakistan flood actually caused a downgrade. So this is a real example of how water management or physical climate risk or flooding is impacting credit already. And then, of course, we have degradation quality, which will impact, again, we talked about clean water, safe water. This will impact, erodes reputational risk, but also impacts regulation risk. So, overall, to your question, water management is not something new we're looking at. It's already impacting our credit metrics. And if anything, we have a lot more debt which have moderate risk, and that could seek up to the high risk.
Well, I think that's good news that the financial markets are starting to price in the risks coming from water. So, yes, let me now focus on the impact of this water risk on emerging and developing countries. So, Hélène, your research explores how biodiversity and nature-related risk, and in that broader frame, also water risks, translate into sovereign risks, particularly in emerging and developing economies. I would like to ask you, what does the evidence actually show about how these risks affect public finances, external accounts, and the macroeconomy in general? And how is your institution building the analytical work into its country risk assessment and financing decisions?
Thank you very much for the invitation. Indeed, at AFD, the French Development Agency, we did some research and published our report recently about biodiversity, macroeconomy, and sovereign risk. And it's based on a framework and methodology that we developed in order to assess macroeconomic exposure for 158 countries to their exposure to nature-related risks. So we have measured the exposition of production, so GDP, tax revenue, exports, and employment for every country out of the 158. And what we found, some of the results are that, as you mentioned, low-income economies are the one with the highest exposure to these nature-related risk. To give you an idea of the size and the magnitude, it's over 50% of production and more than 65% of exports that are generated by economic activities that rely strongly on at least one ecosystem service provided by nature. High-income economies are less exposed, but still they are exposed at a significant level because we find that it's over 30% of production that are exposed to strongly to at least one ecosystem service. We are able to disaggregate and to look at each ecosystem service and to rank which one is the most critical one. And from what we see is that the 5 that are related to water, namely water supply, water purification, water flow regulation, are the ones that present the highest levels of criticality. And again, we see that low-income countries are most exposed to that issue than high-income economies. On average, the production of low-income countries is dependent of, at the level of 35%, on these water ecosystem services. With such macroeconomic exposure, the interruption of alteration of ecosystem services would have impacts on the economic situation, on export earnings that generate foreign exchange to repay external debt, and as well on public finances. And that's why we integrate that now into our sovereign risk assessments. To give you an example about an illustration for a middle-income country, Morocco or Indonesia, in these two countries, it's over around 35% of exports that are dependent on water ecosystem services, and 25% of tax revenues. So it was stressed earlier in the previous session by our colleague from Morocco that it's a water scarce country, so that's why it can have huge impact on the economy. So from that data that we build, within AFD, and mentioned it, we integrate this quantification of water-related macro-financial risk into our internal credit rating, credit risk assessment, because we are a bank as well and have to integrate that dimension within our rating for sovereigns to which we lend. And in parallel, we support Ministry of Finance and central banks in several countries in the world in order to assess nature-related risk with that tool that we developed. And discussing with Ministry of Finance is quite a powerful tool and powerful way to highlight, to call for action and call for investment. And we are able to identify quite precisely where the risk lies, which ecosystem services is more at risk, and which one is worth monitoring or investing to remediate, to build resilience.
Okay, so from the data that you just presented to us, we can really feel that economies in emerging markets are really suffering the effects of water stress. So now let's focus on one developed country, for example, Spain. Esther, from your institution vantage as an independent fiscal authority, I would like to ask you how are water-related shocks currently showing Spain's fiscal picture, and where are the contingent liabilities most underestimated, and what does that tell us about fiscal frameworks more broadly?
Thank you, Noelia. First of all, I would like to thank you, thank the organizers for the invitation to this conference, to the OECD, to the Bank of Spain. For me, it's a real privilege, as you can imagine, to be back at home and to be with you, Juan Carlos, Noelia, and of course, with the rest of panelists. When, as Juan Carlos was mentioning previously, if one could ask why a central bank is interested in this topic, the same question could apply to a fiscal institution with the additional thing that we don't tend to have too much resources. So in our case, the question is more significant. I would say that, of course, water-related shocks are affecting Spain already affecting Spain in a way, in a significant way, with an intensity that is changing the way that we do fiscal analysis. I will try to show you why it's so important for an economy as Spain in the next 4 or 5 minutes, and what are the works that we are doing at IREF, at my institution, my fiscal institution, to address the topic. The question why is so important is not surprising. We are living in the fastest warming continent in the world, Europe, and in the case of Spain, we have seen recently a lot of events, floods, droughts, water scarcity episodes that is affecting the functioning of the economy and of the country. These events have, as Noelia was mentioning previously, have significant implications for public accounts, You can imagine compensation to households, compensation to firms, to some sectors, agricultural, construction, and also investment in rebuilding, in reconstruction, in infrastructure. So you can imagine that public accounts are really affected by these events. So from our perspective, we think, and we tend to have the view that well, they are becoming really a key test, a core test for fiscal planning. So we began to thought that we need to integrate in our analysis. We cannot rely more on just only a baseline scenario for debt and deficit. We have to introduce this uncertainty and other events in our estimates. And this is the direction that the reform of the European fiscal framework has taken in recent years. As you know, we have a reform of the fiscal framework that entered into force 2 years ago. And the reform says that, according to the new provisions, member states are now expected to integrate the macro fiscal implication, not only the macro, but also the fiscal implications of climate change into the analysis of public accounts, into the analysis of public debt sustainability, and also to quantify contingent liabilities and to analyze fiscal risk. However, as was mentioned this morning by a lot of people in this room, putting these requirements into practice, operationalizing these requirements faces a significant, I would say a significant, not significant challenges, a significant challenge, which is that data on water-related costs from the fiscal perspective is really, really scarce. We have some international data sets, such as the MDAT, that tries to address this lack of data. But in the case of Spain, we have found that it does not provide the full picture of all the risks, the fiscal risks and fiscal costs we are facing. And at the national level, of course, we have a lot of information about events that is somewhat dispersed across ministries or agencies, but we have very good information about events, but we don't have any source of information about the fiscal cost of these events. I must say that in the case in Spain, the institutional response to this type of water-related shocks takes two forms. The first is the one assumed by the Insurance Compensation Consortium. I've seen here the responsible of the consortium, that in normal situations is the key absorber. It can absorb the cost of normal events. But in case of extreme events, well, the resources and reserves can be exhausted. They may face some structural limits for compensating households and firms. So we have a second element, which is the discretionary action by our government. And the issue in Spain that has allowed us to identify the fiscal costs is that they need to these discretionary actions need to be approved by the Council of Ministers, and they need to be published in the references that they publish every time they meet. So that's the gap we try to address at IREF. We have undertaken a very demanding and challenging project to construct a new data set on the fiscal cost of natural disasters in Spain. To do that, we conducted a textual analysis of these references of the Council of Ministries using artificial intelligence techniques. We have identified more than 400 natural disasters in Spain in the last 20 years, and we analyzed close to 1,500 policy measures. We will publish the results in just 2 weeks, so you have to take time to read our report. And here I like to stress well, the main points and the main results of our analysis. The first and very interesting for this conference is that we find that water-related shocks are one of the most important categories of climate-related fiscal risks in Spain. The first one was the pandemic. The second one are water-related shocks. And over the period, the last 20 years, the cumulative fiscal cost of policy measures in response to droughts and floods was about 20 billion, here billions, not trillions, we are a small economy, was about 20 billion, close to 1%, 1.5% of GDP, including the losses assumed by the consortium. It seems a quantity in 20 years that it can be accommodated in our budgets. The most important question is that the distribution of risk is really, really highly asymmetric. Just only one event, the floods that we have experienced in Valencia 2 years ago, accounted for more than 10 billion, which is close to 1% of our GDP. And it was really, really above any previous hydrological disaster. Our data allows us also to identify what the composition of shocks. Floods represent 80% of this amount. Droughts are different. They develop over months, and the fiscal response tends to accumulate more gradually. We can identify not only compensation to households, we can identify also investment in resilience. And in the case of droughts, for example, one interesting finding is that the response seems to be shifting from investment in resilience to compensation to households. That for us is important because compensation, of course, tend to smooth the immediate damage, but it does not necessarily reduce future exposure. So, well, we are working there. We need to work more. We need to collect more data. But for me, and in our view, integrating and improving the analysis of this is not an option. It's something that it needs to be accommodated in the fiscal analysis we do.
Yes, I mean, listening all the figures that you have provided here, I mean, we can really feel that water risks are materially important for fiscal balances, of course. It's true that you are taking steps, maybe small ones at the European level and also at the national level, but the feeling is that physical water risks are not fully integrated in the fiscal frameworks as yet, due to problems with the metrics, information gaps, modelization, and many other things. But yes, it's like a task that we still have to face to keep on working on this. So this is really bringing us to a broader disconnect in how these risks are assessed and how they are managed. So, John, most water risk frameworks were built around environmental and operational concerns, not fiscal ones. But from your global perspective point, where is the disconnect between how water risks are assessed on the ground and how they show up or do not show up in finance ministry and treasury thinking?
Thank you for that question, and I also want to thank the organizers for the invitation to come here. It's been an amazing discussion. I feel like I've learned quite a bit already. And if you're not familiar with what AGWA stands for, it's the Alliance for Global Water Adaptation. We're a global NGO about 15 years old, co-founded with the World Bank to look at the nexus of water and climate change. So this space about our body of knowledge and how we see, especially water and climate risk at the kind of asset level versus at the level of a finance ministry or a treasury. It's a big gap, but I also feel a little encouraged over the course of today so far that, at least in some elements, it's really starting to close. I'd say, as an initial comment, we know a lot more, have improved a lot more at that asset level, at the level of an individual project, and there's been a huge amount of technical expertise that's really developed there. I think that the gap is really in the second part of the question, really how we start to think in a Treasury Department, in a finance ministry, in a central bank about where these issues play out, what the implications are. And the gap is real, and it has been persistent. And to borrow maybe a comment that Kate made in her initial comments this morning, she was asked, what is the one thing that we could do differently? And she said, systems thinking. And I actually think that there are probably at least 3 systems that we should be thinking about when we think about financial systems. And the first one is the one that probably the most work has also happened on, and that's the kind of nature and climate systems that we know a fair amount, at least in terms of direct physical impacts, about how to count that. And the big lessons, they're not really in terms of knowing on May 21st of 2043 exactly what's going to happen on the climate that day. But the big lesson is actually maybe to pull from the previous speaker that we actually know that we have no idea what's going to happen that day. That actually the uncertainty is one of the important lessons. Maybe to draw on Juan Carlos's opening remarks, the science actually tells us that the science can't tell us that much. And that's an important statement. It can draw some error boundaries around what might happen, but actually, like, the decision space is much larger than it had been. So the term that's been used, especially with regard to water resources and the kind of emerging climate risks, is deep uncertainty, a term coined by an economist from the World Bank around 2012, Stefan Huygat, fantastic paper if you haven't read it. But the idea of deep uncertainty is like we may be getting wetter, we may be getting drier, but it's very difficult to say, especially if we look past 10 or 20 or 30 years, exactly which one we may be heading for. So how do we prepare for both, right? And it's very expensive to prepare for both of those. And so the lesson, I would argue, from science is that we need to focus on ideas where we build on resilience, kind of relating to the previous panel. So instead of saying, like, this is the number that we can use to manage water in 2050 or 2035 or this year, we may actually need to step back a little bit and say, we need to actually invest in flexibility. We need to invest in decision-making systems that allow us to become robust in an incremental way. And that's a very different approach than most governments, most institutions have treated water. We've treated that we can look at the past 30 years or 50 years and we'll know what's going to happen in the future. And that's not a safe, it's not a sound, it's not a prudential decision at this point. The second system that I think we need to be interacting with is the governance system. And especially with regard to water, that is often not just how we adjudicate conflict or manage relationships, it's also how we bring on new sectors. For instance, Microsoft spoke earlier today. The tech sector and its relationship with water, it's a new relationship. Where we have a new series of seats at the table that we have to make room for and have to decide how we organize around them and how we allocate water for these areas relative to maybe much older parts of our economies and our societies, like agriculture. And they may be economically really important. We may see them as critically important in the future, but we also have what you might call legacy parts of the economy that we also need to include and address. An example of the kind of big think that can happen inside of governance and allocation systems is the Colorado Compact. It was for the Colorado River in the US. unfortunately did not include Mexico, still doesn't really include Mexico. But it was created around 1923, and it created a whole series of water-sharing relationships for about 30% of the US, a huge part of our geography. And the kind of core part of the southwestern region of the US, at the time of the signing of the Colorado Compact, it only had around maybe 300,000 people. It has 44 million now. And it's because of the Colorado Compact. It was essentially a master plan of making water the kind of economic fuel for what development was going to happen. It made California rich. California was not a rich place before then. And that's a powerful idea because right now the Colorado Compact doesn't work anymore. And the reason it doesn't work is because it's a set of governance and allocation relationships that no longer match the climate, and they haven't matched that climate that it's in for at least 30 years. And it's proving extremely difficult to renegotiate those relationships. So the governance system is actually, it can exacerbate and impact. It goes well beyond those direct physical risks that we see in the nature and climate system. And we need to think about it because the insights behind the Colorado Compact, that's what Ethiopia uses. That's what India uses. It's what China uses in how they think about water and their future economic development. And the third area, I would say, the third system that we need to think about is the political system. The political system is where we develop consensus and priorities. And this is also a very serious challenge. There are good things and bad things that are happening in that space. And to use maybe two examples from the US again. Florida, I would argue, is a bad example. This is a state in the US that's highly exposed to increasingly more severe extreme climate events like hurricanes. At the same time, it also is having increasingly severe water scarcity events. Puerto Rico, a little bit to the right of Florida, for instance, a few years ago had 2 Category 5 hurricanes hit it in the same year. It still has not recovered from those 2 massive storms. The legislature and the governor in Florida don't believe in climate change, and they have forbidden it from being included in policy systems. They have downgraded climate issues in terms of how they should be thinking about the state's economic development. And I would argue that's a pretty big risk, and it's going to influence the way the state, say, makes its infrastructure investments, its bond agreements, the way that they relate to Moody's in getting their credit ratings. California is a very different state. They have prioritized climate change. In fact, the governor for the state, Gavin Newsom, he actually says we don't need to just talk about reducing risk. He literally said something like, we don't need to talk about how to like shave a minute off of our showers next year and keep doing that every year. What we need to be doing instead is thinking about how to show that California is a water-abundant economy. That's how we got rich in the first half of the 20th century. And if we don't show that we are a water-abundant economy, then people will de-invest. They will leave the state, and they will deprioritize coming here. And these are scenarios that are playing out in many countries around the world right now in terms of this kind of tension and dialogue. Those are extreme examples, but I think they're important. What are the implications for to go back to the original point of your question, how should a central bank be thinking about these issues? And I'd say be very careful with climate data. There have been a lot of references to data, and I'd say that climate data in particular is very easy to misuse. And the most progressive institutions that I know in the financial space and how they approach climate data, they are very conservative with it. They focus on the error bars, not on the middle, and not on the means. And they're also interested in what's past the error bars. So all of that data is actually really important. Another a big issue is to focus on the transitions that we're headed towards. So some of those transitions are really significant and large. For instance, in many parts of the world where water accumulates during the dry season, accumulates during the wet season as snow at a high altitude and snowpack, that's going away. That we're essentially seeing, even when there's no change in annual precipitation, we're seeing a change in when water actually is present in our rivers and our lakes. It's mostly, we're losing our natural reservoirs of water resources. So that's something that actually is a high confidence outcome. We can predict it. We can also compensate for it too. It will require significant investment, and we can work in that space. But it's something that the financial system should be seen as a kind of long-term, high confidence impact. I think there also are going to be really difficult choices that are coming ahead. Someone mentioned in the last panel, I think, about sea level rise, and I'll use that as an example. Sea level rise, so far, it has been very incremental, on the order of like less than a centimeter a year. But that's going to change. I'm not sure exactly when it's going to change. No climate scientist would actually tell you with any confidence. But we will see sea level rise in the order of several centimeters in a year, perhaps tens of centimeters in a year. It will accelerate very rapidly and very suddenly during periods. That is, we actually need to be thinking about the change in value of our coastal areas, right? And that's going to be a very complicated process in countries with coastlines. And the financial institutions will experience that as a massive shock. And I would say the insurance companies, the reinsurance companies, their backstop is actually the political system and the official financial system. That they will have to step in for these kinds of crises. My last point, and it's an example from Spain, it's also about how we start to think about how to leverage not just the risks, but actually the opportunity that may be around this, to go from just simply reducing risk to actually kind of an enabling a resilience approach. And I'm going to use Spain as an example there. Spain has had, as an excellent and long-standing drought insurance program. It's worked for farmers over the last several decades. At least 3 times it has actually zeroed out. It's run out of money because of the strength of the claims. And so the national government has been the source of refilling that container. And each time they've had to refill it more. I think one of the insights that's happening with a lot of state-mandated aspects of the financial system is to say we don't need to pay people just for damages so that they can keep doing the same thing. We need to pay people so that they do something else, that they need to make some kind of a transition. Maybe it's a different kind of crop, maybe it's a different season or different kind of agricultural methodology. Maybe it's also reprioritizing the agricultural sector versus another sector. And those are the kinds of changes that we can expect to be making much more regularly and consistently going forward. Thank you.
Thank you, John. At the end of the day, what you are just suggesting is that we have to have systems thinking. Water problems need to be faced or understood in a holistic way. What we need to do is link infrastructure, governance, of course, and a political system that promotes the right incentives to face these risks. So now coming to you, Tim, I would like to ask you about public investment. you know that public investment in water infrastructure is often seen as a key lever to reduce exposures to water-related shocks. It's coming back again to what John said before. It's important, the resilience investment. So from your perspective at NWB Bank, Tim, how does this investment actually shape the exposure of different stakeholders to water risks? And in particular, how does the impact differ between entities directly responsible for water management and those that are more indirectly exposed?
Okay, well, thank you first for having me, and maybe as a small introduction on the bank, so setting the scene, NWB Bank is a promotional bank in the Netherlands and is pursuing government policy and financing public sector actors, so schools, hospitals, water authorities, drinking water companies and housing associations in a nutshell. So maybe I think during the day it has been mentioned over and over again that water is affecting all sectors, so it's also affecting the public sector. So that's not a surprise, I guess. But maybe it's interesting to make a distinction here between those who are directly responsible for the management and others. And if I look at those responsible for the management, those are the water authorities who are responsible for flooding risk, for water quality and water quantity, and drinking water companies who are, of course, responsible for providing fresh water. If I look at those institutions, how does it show up in their balance sheet? Well, it shouldn't be a surprise that due to the changes in climate, their duties become more and more challenging. So, and challenging that will, of course, result in higher costs. So that's, I think, on their balance sheet, the most prominent effect you see. If you look at the other institutions, I think, and I mentioned housing associations, when, well, there it shows up in the assets, so damage to assets due to pluvial flooding, or asset valuation, because they are located in areas which, well, might not be sustainable in the long term. And of course, those two are intertwined. Actions from one, so the water management authorities, well, impact the others. If there's more flood protection, of course, the asset value of the housing associations will increase. On the other hand, if the housing associations build water-efficient homes, then the management of water and the supply of fresh water will be less costly. So there's an interaction between those two. And, well, just, I think, context is important. It was mentioned before in water, but it's also in the budget, I think. So you have to look at how it is organized in the country. If I look at in the Netherlands, which is very useful in this respect, I think, worth highlighting, that water authorities have tax raising capacity. So that's a real distinction, I think, to situations where it relies on the general government budget. First of all, it is a bit out of the political arena of priorities, and second of all, it is not directly in the budget of the government. So that's one element. Another example which I would like to mention in this regard is the Delta Fund. It is anchored in legislation, and it is attached to the Delta program. It's a long-term program, which is, again, it makes money strictly for that purpose, and we are talking about long-term challenges. So I think that is very helpful. It's also helpful to consider what is the impact. And maybe lastly, and it also relates to the comments made earlier on resilience, if you come to think about the investments, it is quite important how investments show up in the budget of the government. So you were telling about budget constraints, but it's also the way of how it is accounted for. Is it accounted for as spending? And to me, if you are talking about resilience measures, I would say it is a measure of investment. So accounting for that in budget as spending is not really helpful, first of all. It is, of course, limiting the ability to do the investment. And it's also not reflective of what you are doing. And not only economically, but I also want to stress socially, because investments you do today, they are not for the generation now, they are for generations in the future. So it also makes sense that the burden is carried over generations.
So reducing exposure is not only about spending more, but how resilience is planned and embedded in public frameworks. It's not a thing that really depends on the amount of money that you invest, but if you invest in the right way. So, John, coming back to you again, what does it take to integrate these two so that resilience investment are viable, visible in fiscal frameworks and risk reduction, not just expenditure? And what is the shift in how governments plan and budget that would most reduce fiscal exposure to water shocks?
It's a challenging question. And I'd step back maybe a little bit, and I'd say that one of part of the ethos, I think, of this meeting is the idea that we need to have fiscal stability. And I'd say that we're actually really challenged in that process when we have climate instability. And that there's a really deep tension there. Again, referencing Kate's talk this morning, water comes from climate. It doesn't come from necessarily landscapes, or certainly not from pipes. So we need to think about what happens when the climate is actively changing, is going to continue probably for many decades or centuries at this stage. So there's a tension, in effect, that exists between how we manage, how we conceive of resilience planning versus how we think about fiscal planning. And I'd say that the measures that we use for those two things, that they are to some degree in conflict. Resilience planning, you're looking at how assets, how flows, how stocks are going to change over time and evolve, and what you need to do to be able to compensate and adjust for them. And then for fiscal planning, what we have been using primarily is the concept of efficiency. It's a very old economic concept. It's a part of the deep ideas within going back to Adam Smith, and resilience and efficiency are not the same, and they are in tension with one another. I would argue a highly efficient system is probably not one that's going to be resilient. It probably is brittle, and a resilient system is not going to look that efficient because you're paying for extra things. You're building in redundancy. You're building in some flexibility. You're adding to the robustness of the system. And so I would argue that in effect, what we need to do is find some kind of reconciliation for that. We need to add some resilience to our concept of efficiency. And part of that is that we also need to be able to really measure what resilience looks like. Resilience, at least in my world, is one of the most overused and underdefined words. We have often kind of a, it's a word that we often politely sort of ignore any depth to it. It's but Andy Roby earlier today, he was talking about the Global Goal and Adaptation, the GGA. This is part of an effort within the UNFCCC framework to actually come up with specific measurable indicators for resilience that say if you're moving towards it or away from it. If you're to be able to inform decisions that increase resilience, or if a decision or action is not resilient. And that's a huge change. The MDBs have a working group actually on this topic. It started about 1.5 years ago and has continued to build work. Agua, in partnership with Deltares and ARUP and EMI, has been working very actively to try to develop indicators in that space. So there is a lot that's happening, but I don't think it's kind of made that transition into thinking at the level of economic planning in general, much less kind of more specific fiscal planning efforts. Juan Carlos also mentioned in his comments just in the beginning here that there were kind of 2 central major points that he thought were big advances in the area of climate change, and one of them was stress tests. I completely agree with that. That point is a fantastic point. And I think that these stress tests are probably where we can see efficiency and resilience begin to work together. We can explore ideas in a stress test about when we need to be efficient and when we need to be resilient. And we can use it as kind of a hypothesis testing mechanism, especially if we kind of open it up from just the direct physical risks and we start to think about some of those allocation and governance issues and maybe some of the larger political economy in that space. And like a simple example of this, we have a program that it's called the Water Resilience Tracker, and it's really a kind of policy and governance engagement around the concept of resilience. We work in around 15 countries so far globally. We'll probably add a couple more this year. It's been around for 5 years so far. We mostly work at the national level, but some countries we work at lower levels. One of the countries that we view as our most important partners on the tracker is Brazil. We've been working there for about 3 years. And the tracker, it almost uses a kind of Socratic methodology in terms of being able to kind of ask provocative questions across ministries. We've worked with around 11 ministries so far in Brazil. And that process in such a big, complex country has really revealed some interesting patterns. For instance, when we went to one of the agriculture ministries in their 5-year in DC, their 5-year climate commitment under the UNFCCC, they said, we want to triple the amount of irrigation in Brazil within a 5-year period. This is a very irrigated country. They already irrigate a lot, but to raise it by that level over such a short period of time is impressive. And, we were surprised by that, and we said, that's great, where's the water coming from? And they literally said, that's not our problem. So just over 1 year ago, we had a workshop on the results from that kind of initial assessment in Brazil, and we kind of presented some of these kinds of gaps. The first person to stand up, of the 11 ministries in the room, first person to stand up was from the agriculture ministry, and he said, it is a fundamental error of our ministry that we did not prioritize water and how we thought about resilience. And I regret what we said and did. And we will change that. And that is a powerful epiphany, right? It is a deep change that's happening. And I would argue that it is that shift from efficiency to resilience that's occurring in that space. So maybe just as a final quick point, I think that there's also the focus on risk is so important. It's how we see the dangers that might be coming ahead, but we also, I think through the planning process, it should be how we also see the opportunities that may be coming up. And that's a big thing. We need to be thinking about the positive things that we might be able to take part in and to become connected to. That there is a risk of actually losing those opportunities if we're not looking for them and trying to find them. Thank you.
Thank you. Well, resilience is a word that we are listening all the time here in this session. But resilience needs investment and financing, of course. So, Tim, from your perspective as a public financial institution, how does this play out in practice? Under what conditions does the investment case actually work? And when it does not, which are the main barriers to it? And briefly, what does this imply in the way public development banks assess and manage their own exposure to water-related risks?
Okay, well, I think
long question.
Just for the first question, when are investments successful, if I may deem it like that, define successful, but okay, that having said, I think what is key is that ownership and requirement is clear. If it is clear who is responsible and what is the requirement they have to adhere to, then the financing system works. In our case, okay, we are able to attract funding at attractive levels in the market due to our AAA rating, due to our non-profit nature. We can give it at attractive rates, and that works. If ownership and requirement is not clear, then it becomes a bit difficult. And what I mean, if requirement is not clear, then there's uncertainty about cash flows, and I think it was also mentioned earlier in discussions. You have some capacity building. What are the cash flows and who's entitled to the cash flows? So if you look at, for instance, water efficient building, it would be in the interest of several parties, but one party is bearing the cost for it, and that's problematic. And I think that leads me to what was mentioned before. We have to think about systematic. So we have to bring together all parties, and it's also related, I think, to the question, to the statements before, that the price of water is not the same as the value of water. And in my opinion, the case which was mentioned by Microsoft is illustrative for that. If you see the one who is responsible for the leakage of the system, well, he does the math. He says, okay, I have to repair it, cost X, and the price I get for my water is very low. So it's not economically. Well, on the other hand, Microsoft says, okay, for me water is very important to run my business, and from that I'm willing to pay for the repair system. So I think bringing together all stakeholders is very useful and helpful, and it bridges the gap between price and value, and also about the distribution of the benefits, I would say. And well, without, which was mentioned before, that data is a lot of uncertainty. Also the tipping point is very difficult to see, but given an eye on 5 o'clock, I leave it here with my comments.
Yeah, so really when resilience investment is timely, credible, and well-designed, it can really reduce the exposure to water risks rather than just shifting costs or potentially affecting credit quality. So run from what Moody's Ratings is observing across sovereign and sub-sovereigns, what role does the timing and credibility of resilience investment play in whether water stress remains manageable or becomes a source of sustained fiscal and credit pressure?
Great question. So I think timing ultimately means that whether a risk is absorbed manageably by CapEx, or it becomes an operating issue, or it becomes an emergency spending, which is, means more CapEx or more OpEx. So I think timings are very important, but also within the credit analysis, it's for us less about hydrology, but it's more about the cushion around any kind of risk. So the three things which is kind of important to credit analysis is the water governance. So we've heard water governance many times today, but what does it really mean? It's about allocation framework. It's really about, ultimately, at a very high level, given the limited supply of water, how is a sovereign managing that? How is a sub-sovereign managing that? We saw the Dana floods with Spain, but although the exposure of issuer profile scores within what we score in Moody's, they increased, but the credit risk didn't increase just because they had the financial flexibility, the fiscal capacity to weather the weather.
To cope.
Forgive my pun. So it's really about water governance. Secondly, it's about infrastructure adequacy. So storage levels. Look at the desalination plants within the Gulf right now. Looking at amount of storage levels they have is an important part. But also, it's about how is the infrastructure working. I think an important point we look at is redundancy. So that means, what about the leakages? So I think we've heard earlier today about Costa Rica. I think about 60% leakages. That's normal for a lot of the countries. Is high double digits. So we're talking about what new things can we do. But the biggest problem is currently what is happening now and how are government letting it happen. So infrastructure adequacy is very important to us. And then thirdly, financial flexibility, which is the core of credit analysis. And this is where different countries with a similar kind of water stress have different exposure or credit exposure to the risk. So by financial flexibility is, again, able to put money where the mouth is and essentially absorb that risk. But also, being able to fund certain infrastructure, adaptation infrastructure, resilient infrastructure early. And just putting on some numbers there, World Bank estimated that's a shortfall in spending of 31 to 47 billion for low to middle-income economies just to access safe water. And also, another interesting fact over here is figures show that water sector only executes 72% of allocated budget. So there's a lot of new things we could do, but what about the current things that can happen right now? But also, there are positive stories or good cases that we've seen across sovereigns. We see Singapore, which is one of the most water-stressed countries in the world. Their four-tap policy governance, being able to recycle water and so on and so forth. They're AAA country doing very well looking at the exposure. Then again, all of GCC Gulf nations, again, some of the most water-stressed countries being able to manage the water stream. So there are examples out there. That's not magic one that we need. There's examples out there that we could look at looking at the exposure. And then finally, just very quickly, capital markets are starting to respond. Within Moody's, we have a sister company looking at second-party opinions, sustainable bond markets. So a lot of sustainable bond markets linked their use of proceeds to water projects is increasing. There are increasing KPIs looking at different system which could impact how the bond assessments are rated to improving water quality, improving water projects. So we are seeing the shift of water investment going from cost to a strategic investment for adaptation and resilience. So I'll leave it there.
Yeah, thank you. I mean, you could say really that outcomes are driven not just by investment, but by how well risks are identified, measured, and priced. So according to your experience, Helen, what does the analytical frontier on nature and water-related sovereign risks actually need, in your opinion? And what is the methodological gap that, if closed, would most change how finance ministries, rating agencies, and development finance institutions engage with these risks?
Thank you for that question. And speaking of analytical gap, methodological gaps, and frontiers, I think that I see three main dimensions. The first one is about improving quality of data about the actual condition of water-related ecosystem services, because it's not always available and known about whether it is in a good shape or not. So that knowing about that would maybe moderate our evaluation of the risk, because if a country is exposed to water-related ecosystem services, it's better if this one is in a good shape than if it's not. So knowing about the condition of these ecosystem services would help a lot for assessing the actual risk. The second dimension is about one that you spoke earlier, about opportunities. There are not much modelization yet that was made about the economic benefits of investing in water preservation and adaptation. I know that there are some ongoing research going on how to modelize macroeconomic gains of these investments, and maybe that could as well liberate some fiscal space in the future, and that could be measured. And lastly, a lot of strategy for a lot of countries have made some list of what are the investments that are needed, namely in national adaptation plans, in NDC. The lists and investment needed are available, but we know less about how much governments are already spending on and investing on these. And some countries are trying to look within their budget at every budget lines whether it is or not contributing to adaptation. So France, for instance, is doing that, and I think Spain is also doing that, trying to do budget tagging and actually reveals to the public and to the other authorities about how much is already being spent to tackle these risks. So, and I think that would help to have this clarity and to know what is already in place to mitigate the risks.
Okay, so now let me ask you, Esther, from your perspective, which are these key gaps that still need to be addressed to better integrate water-related risk into fiscal frameworks? And in particular, if it would be great if you could share some concrete examples from Spain that illustrate these challenges.
Thank you, Noelia, for your question. Well, within that, building fiscal resilience to water shocks and to climate, more in general, climate-related shocks requires perhaps a simple but very, very demanding approach. First, we need to measure the risk properly, and this is the most important gap that we need to face. Second, as many of you have mentioned, reducing exposure and vulnerability. And third, when extreme events occur, we need to design instruments that allow us to smooth or to share the impact on the budget. Regarding measuring, well, of course, I was, in my previous intervention, I was mentioning that we are improving the data that we have to analyze the past, how has been the past fiscal cost of these events for the Spanish economy, but we need to predict for the future in order to prepare and to ensure that public finances are prepared to accommodate the impact. We need to predict how likely is going to be and how severe are going to be these events. There are some methods in the literature. Of course, at IRF we have tried, on the basis of the past costs, we are trying to predict what could be the probability of having an extreme event. We have estimated a fiscal loss curve that allows us to link the size of a possible fiscal loss to the probability of this event occurring, and we find that there are significant costs. For example, we find our estimates show that the fiscal cost could be around 10 billion euros for an event, for a 1 in 50-year event. So this is perhaps not very much for big countries, but for us, 10 billion is close the amount that we spent in housing policies in 1 year. So very significant effects. And of course, these estimates are based on past data, and we know that these events are increasing in frequency, increasing in severity. Tim was mentioning there are non-linear effects, tipping points. Extreme events are not just only the large version of small events. So we need to improve very much the analysis that, and on top of that, we are finding that some events tend to compound, they tend to interact, droughts, wildfires. So we need to improve very much the analysis in order to know what is exactly the magnitude of the challenge we are facing. And that's the main point we need and the main gap we need to improve in order to build fiscal resilience. Regarding reducing vulnerability, I think that Helen and team have mentioned that we need to improve the design of our budgets. There is an approach that is that is being really encouraged by the European Commission and also the OECD, which is called green budgeting, and I think that's the way. It increases a lot the transparency that on the efforts that the different countries are making in order to face these challenges. So I think that's the way. Of course, it's still at a very early stage, but that's the way. And just finally, a final comment to smooth the impact of these events, these extreme events, when they occur. You were asking me examples. I think that in Spain we have a very good example of a very good instrument that allows public budgets, which is, of course, the Insurance Compensation Consortium, the Consorcio de Compensación de Seguros. It's a very good instrument that allows us to smooth the impact of these events, not only across time, because they build reserves when there are no significant damages in order to face the more extreme events, but also to smooth the impact between the public and the private sector, because they are financed through surcharges in insurance premiums. So I think it's a very, very good instrument to follow, but we have other examples in some countries. For example, we were reading the other day about the Caribbean Catastrophe Risk Insurance Facility, which has very good properties in the sense that it's a multi-country, multi-risk facility, but the trigger, they follow a kind of parametric trigger in order to assist countries affected by events. They don't look at the intensity of the damages. They look at the intensity of the event, which allows them to deploy a more rapid response. And we have a lot of evidence showing that the speed of the response tends to be highly correlated with the final damage. So, and in Europe, just a final comment, we have the European Union Solidarity Fund. We know it's not a perfect fund. It has a very partial. Its size is limited. It covers only part of the cost, but it's a good instrument. It's financed by the European budget, so it's a good. Perhaps in the future it could grow more, and it's a good instrument to smooth the impact in any particular country.
Yes, in fact, tomorrow we will be having this session on insurance, so I think that we will have a big opportunity to talk more deeply into the role of the insurance as a cushion against these water risks. So I'm sorry to say that we are running out of time. I'm afraid we will not have any space for questions from the audience, so I apologize for that. But I would like to conclude very briefly with the main takeaways that we have heard today in this session. So very briefly, I will just say that it's obvious that the fiscal relevance of water-related risks. These risks are real, are material, and are increasingly visible in financial markets. In fact, sovereign credit assessments are already incorporating these risks, water risks, in financial markets and rating agencies, and it's also recognized as a key transmission channel for physical climate risks. At the same time, the impact of these risks varies significantly across countries, depending not only on exposure, but also on governance and water management. From this session, I think that we have identified that for building fiscal resilience, we require two things: prevention and integrating water risks in fiscal planning. As regards prevention, we are thinking on investment in conservation and adaptation, and to be effective, it's essential that they are timely, that they are designed in a credible way, that they put a clear allocation of responsibilities, and that it aligns incentives of different stakeholders. But there are also operational requirements that need to be addressed to overcome water risk assessment and fiscal planning, from better information and measurement of water-related risks to stronger analytical tools to have a more robust assessments of water risk to capture, for example, non-linearities or tipping points. So taken together, I think that all these elements are essential to move from reacting to shocks to systematically building fiscal resilience in a water insecure world. So let me stop here. I would like to thank our panelists for all your insights and your great discussion. Ram, Helen, Esther, John, Martin. And thank you, everybody, for your attention and engagement. And congratulations, you made it through this day. Okay, so we hope to see you tomorrow. And, well, thank you so much. Enjoy the rest of the evening.